Good afternoon, and I welcome all the participants. And I can see close to 1100 participants, and people are joining in. And thank you very much to each and everyone for joining in into this direct test refresher course. We have 2,500 plus registration, and we've seen sessions where with 2,400 participants. And really, WRC is grateful to each and every one of you for joining in and deciding to enhance your knowledge and listen to the expert speakers. Let me welcome our Central Council member, C.A. Srinivas Joshi sir, my colleague in council, C.A. Umesh Sharma ji, uh, another colleague in council, C.A. Vimal Agarwal, and today's learned speaker for the first session, C.A. Yogesh Thar. Yogesh bhai, welcome. So friends, this has been really an encouraging support from all of you. At DTRC, in a physical form, we used to have 1,200 to 1,400 members, and COVID, although has brought a lot of difficulties, has brought some opportunities as well. And on an electronic platform, we could accommodate. In fact, we can accommodate much more. But the council has approved 2,500 members in one program in a month. That is a maximum. Otherwise, WRC can handle like and is allowed 1,500. So thank you, friends, for joining in. And without much ado, let me now request our Central Council member, C.A. Srinivas Joshi sir, to briefly put across his view to the members. Sir, over to you.
Thank you, Murtuza ji, Umesh Sharma ji, Vimal Agarwal, and our very respected speaker, Yogesh Thar ji. Friends, the DTRC, even though it's an annual event and it's one of the main event of Institute of WRC, and when I was also chairman, we had two events to always look at. One is DTRC, another is our annual conference. And this is, of course, a very important event, not because we learn here the Finance Act and recent judgments, but we will, this particular DTRC, I find there are subjects on international taxation, namely tax treaties or international tax planning or taxation of expats and all. And I think this is a good initiative, and these are the new areas where we need to go as chartered accountants if we are still not in those areas. We have exceedingly good faculties as usual in DTRC, and I hope you will enjoy the whole journey. But today, since today and in times to come, this DTRC, you have best of the best speaker in income tax. So there is no, I thought that I'll speak on something else other than income tax here today in next 3 minutes. Friends, if you see the society's expectations from CAs have increased tremendously over the years, and there is a huge expectation gap. What society is expecting from us against what we are able to deliver. I think whatever we are promising, whether we are delivering or not, the society is really looking at us from that. And our credibility of our profession in future will depend upon credibility of the financial statements that we can generate in the times to come. I think past president on 1st July talked about accounting to accountability and accountability to credibility. And I think that is where we are today. So we were talking on 1st July in webinars and in video conferencing about the future of the profession. And I will just, in a couple of minutes, I like to say about my views on future of the profession. When we were all asked Central Council members as to what you feel profession will be in 5 to 10 years, we said that we look at it as the largest accounting body of the world in coming years, even though there is a big gap still with US. Secondly, we look at this profession as on one side as ICI, complete digitized ICI, and on other side, completely virtual CA offices. And to do that, I suggested that we will have, we should go more into technology. We have advanced ITT labs, not in one in Mumbai, but we need advanced ITT lab, not 6, but 60 in this country. And another is what we need is not the buildings for the branches. What we need is COEs, the center of excellence, as many as that we can do in this country. I said that this particular country, if you see, the India is trying to be a manufacturing hub, It is trying to have Make in India. It is trying to have Atmanirbhar Bharat as a self-reliant India as a mission. If that is so, India will grow very rapidly in coming years. And I think CAs would then prefer the LLP form or corporate form of practice more in the coming years in this. And institute should be ready to support at least 50 to 100 large firms to go global, like China has. That we should also do. See that we support 50 to 100 firms to go global, and try, I mean, give a more relaxation to corporate law of practice, corporate form of practice, etc. Another part is that we will have to do value added services in future. We cannot depend on government work in coming years, and therefore there are subjects like arbitration or insolvency or labor laws or MSME or valuations or international taxations or forensic audit. IFRS should be taken up more by the institute as an alternative to the dependence on government, like 5 crore limits in tax, in both the taxes, direct and indirect. Tells us that in future we cannot depend on government. When we are expecting a huge investment in India because of Make in India or other aspects of COVID in this world, I think we should give more attention, I said, to the capital markets. Capital market would be more vibrant, and therefore we as a chartered accountant should be able to take more interest in being market intermediaries, as investment advisors, as equity research analysts. We should be more active on small exchanges and MSME exchanges. And we said that we should learn more, and institute should be more proactive, probably into derivatives, option, future, hedging, technical analysis, etc. Our presence in commodity market also has to be much more. Another two areas which I think we can identify and really work for is, one is internal audit. If we can go to the international side, unless we can prove in next 5 to 10 years we are chartered accountants are good at international levels as internal auditors, then other institutes would come in. Corporate law and corporate governance is another area. Because of the heavy investment in India, this area would become extremely important for us. In international taxation, we have international taxation, DTAA, and transfer pricing as major areas that would come up as international investments come more and more into India. We must talk of reciprocal recognition, our reciprocal recognition with other countries more, and we should have more representation on international bodies so that our community is helped much more. With the government, our role, I think, should change substantially. Not only we should have pre-budget and post-budget memorandum submitted, we should be a part of budget making process. We should not only say give certificate on CSR. We should be part of CSR, whether it is, we should have the thing as whether CSR is really working in this country. The institute should be with government on that research. We should be not only talking about the subsidies that crores, lakhs of crores are given as subsidies, whether subsidies are really reaching the right level and making the impact and getting the result, is where CA institute should be with the government. In public service, we need hundreds and hundreds of chartered accountants at state and central level, and institute should really, I think, will work to help CAs to go in public service. This will help tremendously our profession in coming years. At the end, I would like to say that for improved connectivity with government, I think all of us would agree that we should have through ARF, that is Accounting Research Foundation, we should go for several research projects. Currently, we are having a research project on how to restart our economy. For example, how we kickstart our economy, and we will be soon submitting. Such a project should be there. UDIN is one a very good area where we can have surveys through UDIN to find out various things on government spending and how it is making impact, etc. On student front, we should have a review of syllabus more often. We should go for not only review of syllabus, but completely the training which we are thinking as the which is more current and more relevant for the coming period. And on tax front, since this is DTRC, I would like to say that unless we contribute to the society, to the government, by way of either tax reforms, tax leakages to be stopped, we should suggest how they are to be stopped and how to improve the tax base. Government will not be with us. If we can do that, I think government will be more with us, and we will be more with government. And it's not only extension of the filing that we will be asking. We'll be asking many more things, and government will also depend on us for many more things in times to come. If some of you who are listening to me, if you have many suggestions about where institute should be, what we should do in future, they are most welcome. Any of the Senate Council member can be contacted. I can be contacted. And the institute website, we have all our relevant details on emails and phone. And please come to us and say where our institute you want to be and how you can contribute to that. With this, I think thank WIRC for giving me this opportunity to be with all of you. And with this, I wish all the good learning to all of you with people like Yogesh. We are always very happy to learn with them. Thank you, Murtuza ji and Umesh ji and Vimal ji for being with me. Thank you, sir. Thanks a lot. Thank you.
Thank you, sir, for your valuable inputs and guidance on the various opportunities. I only want to take a less than a minute, few seconds to just inform that on 17th, since sir touched upon a couple of things, on 17th, 2 to 5 in the afternoon, we are organizing one program on work from home, and where like the speakers and the panel is going to cover upon like an epic or a template asset employee timesheet management thing, office management thing, and we are also talking about a virtual data room where like say if you buy space on the cloud, then your client folders can be created, client can share the data there, and your team can give you an access and do the work there. So that is on the 17th 2 to 5. On our 18th morning 10 to 1, ICI has already signed an MOU with IDEA, which is a data analytics software, and we are doing a three hours training on IDEA tool hands-on, and it is 500 rupees 3 hour CP. But in that 500, everyone will be given a 30-day free demo of the full software. So we can use it for 30 days and then we can decide if you want to buy or not. So these are the two programs. Since sir talked about automation and digitalization, I thought I'll touch upon those. With that, now I request CEO Umesh Sharma to introduce our first speaker for the day. Umesh bhai, over to you for the introduction.
Yes, thank you, Murtuza ji. Thank you, Srinivas ji and Vimal ji to be present here and giving guidance. Now, honorous task to introduce today's speaker, Mr. Yogesh Thar sir, who is currently partner in Bansi Mehta and Company. He has a rich blend of experience in domestic and international taxation, and I can say you that all the participants will benefit a lot from this experience. Sir has in his credit authorship of articles on direct tax, double taxation avoidance agreement, published mainly by Taxman, Chamber of Tax Consultant, Bombay Chartered Accountant Society. Some of his well-known contributions are the Tax and Treaty Guide, published by Bombay Chartered Accountant Society, and his books on domestic transfer pricing, published by CCH, which he has contributed with his partner Mrs. Anjali Agrawal. So, sir has 36 years of vast experience in the taxation, international as well as domestic taxation. So, we are presenting before you one of the renowned speaker from our region. और आखिरी में एक बात बोलना चाहूंगा सर, आपका सरनेम थार है तो उसका मीनिंग तो पता नहीं, पर आपका बायोडाटा पढ़ने के बाद में तो हमको ऐसा लगता है यू आर थॉर ऑफ इनकम टैक्स, जो एवेंजर्स के अंदर वो एक हथौड़ा चलाता था और पूरे एनिमीज का काम तमाम कर देता था, तो वैसे जब आपका एक्सपीरियंस का हथौड़ा चलता है तो सारे केसेस और सारे उलझने इनकम टैक्स की सुलझ जाती है. तो लेट मी प्रेजेंट बिफोर यू थॉर ऑफ इनकम टैक्स मिस्टर योगेश थार. ओवर टू यू सर.
Thank you so much for your kind words. Respected Central Council member Sri Srinivas ji, Secretary Mr. Murtuza, Umesh ji, Vimal ji, ladies and gentlemen. I hope I'm audible. I was told that there are only 1100 participants out of 2500 who have enrolled. And I can understand that. I can relate this to 1990s.
Sir, now 1587, sir.
Okay.
And joining in.
Okay. Because this similar thing had happened in similar thing had happened in 1990s when people like Rashmin Bhai used to take lead to teach us double tax avoidance agreements. And there were very few participants who come to those sort of seminars. And I was one of the fortunate people who started 1 year late. He started in 1990 teaching all of us, and I joined in 1991. And therefore, today's topic being equalization levy, e-commerce, etc. The same mindset probably continues. कि ये मेरे क्या काम का है? And how am I concerned? It concerns foreign companies. It concerns those who are into digital business, etc.
Yogesh sir,
Yeah,
PPT share करेंगे sir.
yeah, one more. Yeah, can you see that?
Thank you sir.
Yeah.
So a lot of things are happening in the world now in the front of international taxation. And a lot of changes are coming in, and Srinivasji talked about future of the profession, and one of the issues he talked about was advanced IT labs and center of excellence and international taxation, etc. So there's a sea change that has happened in the accounting front in terms of India. There's a sea change that's likely to happen in the area of international taxation. If anyone who heard the interview of Mr. Akhilesh Ranjan with Anish Thakur about 3-4 weeks back during this COVID period, he mentioned that there's a movement of taxation on a consolidated basis globally, that it's not the separate entity approach. It's not a separate entity which will be taxed in a particular country. It will be global taxation on a consolidated basis. The aggregate subsidiary holding companies all put together will be taxed. And the rationale is very simple, that people go into tax havens and therefore avoid taxes, and they generate income in tax-free jurisdictions or low tax jurisdiction and things like that. So therefore, the movement is to have a consolidated worldwide tax basis, and so we are moving in that particular direction, and a lot of things are happening on that. So therefore, it's extremely important for all of us to sit down and read these provisions, whether today we have clients or we do not have clients, in this particular area of work. But then it's as Mr. Srinivas put it, that it's something which is really, really important going forward. So friends, here we are. Equalization levy and e-commerce is a subject allotted to me today, and certain statistical facts before we get into the subject proper. What is the importance of this topic? We find that nearly the top 10 largest companies in the world, based on market capitalization, if you list down, 7 out of them are technology companies. You have Apple, Microsoft, Amazon, Facebook, etc., etc. And now we have, Indian Geo shaking hands with Facebook, etc. So huge contribution in the world economy by the IT companies and digital space. And India is the second largest internet market in the world. These are the statistics that we have from Hootsuite and via social sites. And the way the internet usage has increased and the digital market has increased in India, it's mind-blowing. Again, you look at numbers, you don't understand much in numbers, but then there are huge by any standards. And the value, these are the statistics of January 2020, where the value of the digital advertising market in India is 6.6 billion. And then there is bifurcation into various, other sectors. So in the same manner, e-commerce activities as a whole, you find a huge growth in India and elsewhere in the world. Now, these statistics only go to show how important is the digital economy. It is economy itself. It's not separate from the economy. Digital economy is the economy today and the economy of the future. So therefore, importance of taxation, importance of international taxation on this area. Now, if we look at, to spend a couple of minutes on this background, if you look at the background of international taxation, we had right from 1920s, we had this League of Nations, which formulated certain criteria, and there were 4 factors. If you see the last bullet point there were 4 factors which in those days were considered as relevant for the purpose of determining the jurisdiction who should be able to tax a particular company or a particular wealth creator. And those factors were 4: origin of the wealth or income, situs of the wealth or income, enforcement of the rights, and the place of residence. These are the 4 factors which were at that time thought relevant. And ultimately, the 2 which were selected and which remain with us and are still remaining with us even today are the source rules and the residence rules. That is, the source of the origin of wealth is the source, the first factor, and the place of residence of the person who is earning that income or wealth. So source rules and the residence rules are the rules which have been governing our taxation for so many years. The questions came up as to how should the income be allocated when a particular entity is a resident of one country and he's doing business in the other country, and therefore which country has a right to tax it, and therefore these allocation rules came in, and we have, by and large, we have a rule of permanent establishment, and then of course based on the characterization of income as royalty and fees for technical services, we have those taxes. Now, the last bullet point over here makes an interesting reading, which really shows. I'll just read it first. It says it's a famous paragraph in the 1923 League of Nations document on double taxation. The oranges upon the trees in California are not acquired wealth until they are picked, and not even at that stage until they are packed, and not even at that stage until they are transported to the place where the demand exists, and until they are put where the consumer can use them. And these stages, up to the point where the wealth reaches fruition, may be shared in by different territorial authorities. So the principle that the wealth gets created where? Wealth gets created not at a place where your goods are sold, not at a place where the goods are manufactured, not at a place where the goods are purchased, not at the place where other head office is there, etc., etc. The wealth is created at all the places. All the places contribute to the economic activity of the enterprise, and therefore it says that these stages, up to the point where wealth reaches fruition, may be shared by different territorial authorities. So there is a concept of sharing of income and therefore sharing of wealth by different territorial authorities. This particular concept, that the income accrues not at one place but at all places, we find in our own decision of the Supreme Court in Ahmad Bhai Umer Bhai's case way back in 1959, 1960. So this principle remains the same. However, in the brick and mortar business regime, which was there for almost a century now, when these international taxation laws came in, the concept of permanent establishment became very popular. And that concept was really a physical presence test, that if a foreign company is doing business in India, then he has a physical presence in India, and he has a permanent establishment in India, and his business profits would be charged to tax. If he does not do business in India, but he merely does business with India, then there is no significant economic activity taking place in India. He's only selling goods to India, or he's purchasing goods from India, and so on and so forth. And therefore, in absence of that significant economic presence in India, there was no tax or a very little tax. Now, this concept is undergoing a massive change because of the digital world, digital economy coming into existence. And as a result of that, a person who was selling music by way of selling cassettes had to have a shop in Mumbai, and he would sell the cassettes, and then those cassettes would fetch him income, and therefore that shop which earns income in India would be the permanent establishment of that person in India, and therefore he would pay tax on whatever he sells here, etc. However, in the digital economy, that person need not have a shop in India to sell a cassette. He can sell the music sitting at his place in California or wherever he is. And in India, you have a lot of buyers of those musics who would download those music from all these channels and on internet. And therefore, the person who could have his shop in India, physical shop in India, who would have paid tax in India, now does not have a physical shop in India. He has a virtual shop in India, and he does not pay any tax in India at all, or he pays a very little tax by way of technical services or something. So therefore, this is what has been the bone of contention of the developing nations, and therefore we find that G20 nations coming in together, working along with the OECD in the BEPS initiative, and OECD in the BEPS initiative, that's Base Erosion and Profit Shifting Action Plan 1 on the digital economy, articulated all these difficulties and the characteristics of the digital economy, and various business models under the digital economy, and what are the tax challenges that have been created by the digital economy. So, and the tax challenges essentially are three, as you will see at the end of the slide. Nexus. So we had that physical presence test as a nexus. Now physical presence test is not required, and therefore what is that nexus that I have to develop? Because to have a taxing right, I should have a nexus. If the person is not a resident in India, if he is not present in India, then what is that nexus I will develop so that India gets rights to tax it? So a new nexus rule has to be developed. What is that nexus rule? So that is the one tax challenge. Then valuation of data and user contribution. As we all know, huge data is collected by the international companies, having internet access. I mean, you and I have internet access to Googles and Amazons and all. They collect huge data in India. How do you value that data? What is the user contribution to that area? Because the user's contribution to that particular data or the particular advertisement, etc., that user contribution is actually the economic activity that takes place in India, and therefore there should be a right to tax. Now, how do I value that? And of course, issue of characterization of income, because characterization of income, when you say, as I said, I gave example of music. So what? Is it a sale of goods? Is it a sale of service? Or is it a mere license and therefore it is mere royalty? I don't know. Today, all your conventional rules of characterization of income are coming under challenge. So these are the three issues: nexus, data, valuation, and characterization, which are the real tax challenges that have been articulated in the Action Plan 1. Now, therefore, there were proposals that, all right, everyone agrees, especially the G20 nations agrees that there is a need to devise the system whereby the foreign digital companies who are having a huge user base in developing nations are they do pay some tax in all the countries, and not just pay tax in the resident countries or avoid completely because they are situated somewhere in tax havens. So they suggested three alternatives in Action Plan 1. One was an alternative called significant economic presence. So that significant economic presence, we'll have a look at it as we go along. Then there was an option of withholding tax, and there was an option of equalization levy. India was the first one to pick up equalization levy and started after appointing a committee in 2016. It introduced the new equalization levy in 2016 after the committee recommended certain aspects. Now that so in 2016, India initiated this levy of equalization levy. Equalization levy at that point of time and even today is kept outside the income tax law. It was introduced as an interim measure because the three options were suggested by the action plan 1. And while the world is discussing, India cannot sit back, fold its hands and sit back and say, no, 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 I'll do nothing about it till the world, till everyone, is aligned to it, or the US is aligned to it, or the large developed nations are aligned to it. So I can't fold my hands and sit back. And therefore, I started equalization levy. India was the first country in the world to take that initiative after the action plan 1 recommended those three initiatives or three options. It started as not being part of the Income Tax Act. It was introduced in Chapter 8 of the Finance Act and therefore kept outside the Income Tax Act. And then they introduced a section in the Income Tax Act saying that something which is subject to equalization levy will be exempt from income tax, and therefore you don't pay income tax on it. And then if an Indian is paying an income to someone, whose income is chargeable to equalization levy, then that person will not get a deduction unless he has deducted that equalization levy at source, and therefore 40A1B was introduced in the Act. So these are the provisions which were brought. However, in 2016, when these provisions were brought in, the scope was extremely narrow, and it was only online advertisement services which were subjected to equalization levy in 2016. However, in 2020, Finance Act 2020 has introduced equalization levy of 2% on e-commerce transaction, and it has expanded the base of equalization levy significantly. There's a significant expansion of the base of equalization levy. And this expanded base is now live and kicking for every transactions after 1/4/2020. And some of you must have noticed just about a couple of days back, there was the challan of payment of equalization levy was modified to bring in this new particular equalization. So equalization levy of 2016 and equalization levy of 2020, a massive difference, and we will go through a few slides in a short time. But just one more minute on what happened between 2016 and 2020. Equalization levy, as you will, because it's outside the Income Tax Act, there's double taxation because India taxes that advertisement income at 6% on based on the equalization levy of 2016. Since it is outside the Income Tax Act, the person paying tax in India does not get a tax credit in his home country, and therefore in his home country, if he's taxable, he pays full tax, and therefore there is a economic double taxation which is happening. One of the criticisms of equalization levy. India therefore said, look, this is an interim measure. We are introducing this as an interim measure after the world decides that, okay, what is the consensus? We will fall in line with that consensus, and we will demolish this, we will delete this equalization levy completely. That was the thinking. But as of today, there is no consensus, and some actively involved in this entire process in the world tell us that that consensus seems to be really difficult. The deadline was set in December 20, but because of COVID, etc., it is likely to be further extended quite a lot. Now, since not much consensus has been reached, earlier US was completely against any changes because they said no, the traditional permanent establishment rules are good enough. However, and therefore nothing is required. But however, they turned around between 2016 2020. They have turned around a little bit, and then in and around 2017-18, US agreed that there is a requirement of change, and they talked about market intangibles. Initially, India was happy about that, but then India found that US is talking about market intangibles developed by the US companies, and therefore large part of the revenue according to their formula would once again go to the US companies, and therefore there would be large tax in the US itself. Whereas countries like India would say, no, your market intangible is developed in our country because you have a huge market here, and that intangible gets created in my country, and therefore I should get a larger tax. And therefore there was once again discussion, etc., which is going on even till today, no consensus. And therefore, this expansion of scope of 2020, that now not just advertising income, It's a whole lot of e-commerce revenues that has been sought to be brought in to the net of taxation under equalization levy. India brought around also a provision of significant economic presence in Section 9 of the Income Tax Act, which is a formula-based taxation. The world is today discussing and what is popularly known as Pillar 1 and Pillar 2 approaches. And Pillar 1 approach is essentially to find alternative nexus. As I just said, that physical presence is not a nexus, but user base is a nexus or whatever. So find alternative nexus, and how do I allocate income to that alternative nexus? That is the Pillar 1 exercise which is going on globally. And there's another exercise going on globally, Pillar 2 exercise, that there are some shortcomings of the BEPS initiative in the sense that it does not deal with the double non-taxation to a great extent. And therefore, this Pillar 2 initiative, or the talk which is going on today, has basically, as its ultimate objective that a multinational enterprise must pay some minimum tax in every country, must pay some minimum tax globally. So therefore, there are three alternatives which they talk about. One is an income inclusion rule, which says that look, if an Indian company pays tax in India and it has a subsidiary in some other country which he does not pay any tax at all. Now that subsidiary should in India pay some tax based on some formula or some average rate of tax, and say that okay, if the 10% is the average rate decided, and if that country is charging only 3%, then balance 7% you please pay to India. So income inclusion rule. So you must pay some minimum tax everywhere, somewhere in the world. If you don't pay in your home country, then you pay it in the source country. So that is one approach which is being discussed. Then there's a denial of deduction, that if an income is paid by an Indian to a non-resident, then that non-resident entity or that country does not tax, then I will not allow you the deduction of that expenditure that an India is paying. So denial of deduction. And third is a subject to tax rule, where they say that if a particular income is not taxed in a country of residence, then the country of source will not give the benefit of lower tax rate in the which are otherwise applicable under the treaty. So friends, I'm just laboring here for a moment just to bring home the point that huge changes are going on, or huge discussions are going on across the world in the area of digital taxation, and you will find that multinational enterprise is being taxed on a global basis in the coming years. So this being the position, now let us see what India has enacted. These are some of the Indian judicial precedents. I'll not get into it, except by saying that these judicial precedents are on both the sides, whether there is an existence of a permanent establishment or there is no existence of a permanent establishment, and whether online advertisement is taxable, not taxable, online shopping there's a tax or there is no tax. The decisions are, you'll find both ways. These slides will be circulated later on, and therefore you will have the benefit of these decisions. There's one decision of the Delhi High Court which was rendered not in the case of a tax case, but it was rendered in some other case where the question was whether the Delhi High Court has jurisdiction over an entity which has a foreign company, which has a website, and that through that website a business was done in Delhi. And the question arose whether that website through which a business was done in Delhi, and therefore there's a dispute over that transaction, and therefore does Delhi High Court have a jurisdiction over that or not? Now, one would say that in terms of tax, there is no permanent establishment in Delhi. However, the Delhi High Court in that decision took a view that there is some business carried on in Delhi, and therefore there's a cause of action lying in Delhi, and therefore there is a jurisdiction of the Delhi High Court. Now, of course, this has nothing to do with our tax issues, but however, the judicial thinking in the direction that there is a virtual presence of that foreign enterprise in Delhi through which it is doing that business, and therefore it is something where a business is carried on, and therefore Delhi High Court has jurisdiction. A very important decision which shows how the judicial thinking is in the present day changing. Now, with this, friends, let's get into the first part of equalization levy, and which is popularly known as Equalization Levy 1.0. This is a 2016 amendment. As I said, this was introduced as part of Chapter 8 of the Finance Act 2016 as a temporary measure. However, it's likely to stay with us for long because it is outside the scope of Income Tax Act. The questions have arisen whether it is income tax or not, whether double tax avoidance agreement benefits are available or not, whether it is constitutionally very valid or no. These are the issues which crop up. But be that as it may, today this is a tax which we have to read and learn and implement. Now, what is this Equalization Levy 1.0? You have this non-resident. Non-resident is rendering what is known as specified services to a person in India, and in consideration of that, that person in India is paying certain consideration for that rendering of service. And in this transaction, this provision says that when this person makes payment, it has to deduct tax at the rate of 6% on the gross consideration, and it provides a small exemption that unless the aggregate amount of the specified services is rupees 1 lakh in a previous year. So rupees 1 lakh per non-resident service provider per year is the benchmark. Now, the non-resident who is subjected to this tax, but of course it is the tax on his income which the Indian resident person is supposed to pay and deduct and pay. We are told that if the Indian person does not deduct and pay, he will have to pay from his own pocket. This non-resident, if he has a permanent establishment in India, then this tax does not apply. Why? Because that permanent establishment is an entity which is paying tax in India, and of course, provided of course that this particular service which we are talking of is a service which is effectively connected with that permanent establishment. So if that is so, then he is subjected to income tax in India, and because he is subjected to income tax, this levy does not apply to. However, we are talking not of people, not of entities, foreign entities having permanent establishment in India. This law, we are talking about entities who have no permanent establishment in India. And the person who is receiving the service is a person resident in India who is carrying on business, or he is a non-resident having a permanent establishment in India, and the service is taken for the purpose of carrying out of business or profession and not for personal use. So this is essentially a B2B tax, business to business tax. There is no B2C tax over here. So if a non-resident service provider is providing the specified services to an Indian resident who is consuming that service for his personal purpose, then this tax is not leviable. It is not a B2C tax. So this is it. Now, what is the specified service? Specified service means online advertisement. It's only online advertisement. Any provision for digital advertising space or any other facility or service for the purpose of online advertisement, and includes any other service as may be notified. There is no notification so far, but basically it includes online advertisement and services in connection with, or services, any services in connection with the online advertisement or for the purposes of online advertisement. What does online mean? Online means a facility or service which is obtained through internet or other form of digital or telecommunication network. Then what is a permanent establishment? Permanent establishment is defined in an inclusive manner and it says it includes fixed place of business through which the enterprise carries on the business. Now these are the definition part of it. Let's look at the so the inclusive definition of permanent establishment really would mean that it does not only include the fixed place PE, but it also includes the service PE and agency PE and software PE, the way it has been interpreted. The same definition of permanent establishment we have in the transfer pricing provisions. And here the Supreme Court decision where they have interpreted that inclusive definition to mean any and every type of PE, and therefore it's not just an office or a warehouse that you have in this country which will lead to tax. It can be any type of a PE. There can be an employee, there can be an dependent agent, there can be a construction fee, there can be a supervision fee, etc. Now, let's not get into all these technical definitions of internet, telecommunication network. We may come to it a little later if required. And let's get into a small discussion on what did the committee recommend when they recommended this particular levy. Committee formulated by CBDT. There were a host of services which were recommended before 2016 when this law was enacted. However, what has finally appeared in law, as we just saw, is what you find in red bold over here on the left hand side box. Online advertisement or any services for online advertisements are covered, and digital advertising space is covered, and all other services which are listed over here by the committee were not covered in EL 1.0. That is the first equalization levy introduced in 2016. Online means what we have seen, but what committee recommended was it also included radio and television, whether analog or digital. So online advertisement was not only in the digital or telecommunication network advertisement, but also radio and television advertisements or radio and television services were considered as online services by the committee. However, those words do not find place in the law as it has been enacted. So therefore, we have a few questions before we get into some case studies. Are other items in the recommended list by the committee excluded from the scope of equalization levy? Answer is probably yes. Except that they will fall under equalization levy 2.0 of 2020 that we will just see in some time. Then the next question is telecasting of ads or traditional TV covered in the scope of equalization levy? So what are we talking of? We are talking of a non-resident providing advertising space on, say, its Google platform or on its platform, whatever platform it is running. And that advertising space is provided for which an Indian company is making payment. And therefore, that advertising space which it provides, for which I pay consideration, I have to deduct 6% equalization levy. This is the law. Or there is somebody sitting abroad who is producing an ad film, and that ad film is produced outside India. Therefore, that amounts to a service for online advertising. And when he is providing a service for online advertising, there is once again a tax which is applicable. So the question arises as to what is this online advertising all about? Does a traditional television gets covered within the scope of online advertising? We saw in the definition of online, it means facility, service, etc., which is obtained through internet. So television certainly not internet, radio certainly not internet. But is it any other form of digital or telecommunication network? The answer probably could be yes, answer probably could be no. If we go through the definitions, the various definitions that we have as to what is a telecommunication network, we can just have a quick look at those definitions of telecommunication network in slide 25. And there we find an interesting observation that a telecommunication network is a collection of terminals, nodes, links, and any other intermediate nodes which are connected so as to enable telecommunication between terminals. So therefore, a television would definitely come within the scope of telecommunication, a traditional television. However, does it come within the scope of network? Is there a network? And what does network therefore mean? A network would essentially mean that the terminals are able to communicate with each other, and therefore the question arises as to whether the terminals of a traditional television are able to communicate with each other or not. And if the answer to that is no, the possible answer to this question is that no, there is no advertised, there is no equalization levy on the services provided on the traditional television's media. This view once again gets supported by the fact that, look, when the committee recommended a definition, it recommended a definition so as to include radio and television, whether analog or digital. And now in the law, they have not introduced that, and therefore consciously that particular avenue is outside the purview of the equalization levy. Then, therefore, a view seems to be that on the traditional television, if any service is provided for the purpose of advertisement, that would not fall within the scope of online advertisement in equalization levy. However, extremely confusing, and there is definitely there would be litigations in this area, because if you read telecommunication network theory on that, you will find even a cable TV network is included as telecommunication network. And another question which may be relevant for all of us on day-to-day basis is hosting a website covered in the scope of equalization levy. So I appoint a website hosting agency outside India, and therefore can I say that I have appointed a person who is providing me online services for hosting a website is nothing but online advertisement? Can I say therefore that online website is online advertisement? Answer to that also seems to be no. If you look at the definition or the meanings of the word advertisement, we find that advertisement essentially has a push element, that I have to draw somebody's attention, I have to put something in a public notice, I have to do something to persuade people to buy my product or service, and so on and so forth. So advertisement by and large has the concept of pushing something for being noticed by the people at large. However, when I host a website, I'm not pushing it. A person interested to go on my website will go on my website, and therefore it's a pull approach. Therefore, to my mind, mere hosting of advertisement cannot be regarded as a service, online advertisement service, and therefore equalization levy cannot apply. Then let's get into a couple of small case studies on this. That here there is an Indian, ICO is an Indian company which employs two foreign companies, FCO 1 and FCO 2, who are residents of UAE, and they do not have any permanent establishment in India. Now, ICO has acquired the advertising related services from these two companies. The FCO 1 is actually providing designing and creating an ad, a 30-second video. And FCO 2 is providing advertisement on digital media. So it's providing a platform where that advertisement will flash. The questions therefore are, now, so far why we have selected UAE is because the India-UAE tax treaty does not have fees for technical services clause. And the case study says that the fees charged are more than 1 lakh, therefore that small exemption does not apply. And and there is no furnishing of tax residency certificate. Whether there is furnishing, there is no furnishing, it will depend whether treaty applies or treaty does not apply. Now, the first question is, which provisions do I examine first? Do I examine equalization levy first, or do I examine income tax first? If I examine income tax first, I will see, oh look, there is a designing creation. There is that designing creation is a technical service provided to me. But then when I look at the India-UAE treaty does not have a clause for fees for technical services, and therefore that would fall only as business income. And since there is no permanent establishment in India, that business income will not be taxed in India. Again, this advertisement on the digital media, that person has no physical presence in India. Merely allowing me to put an advertisement on a particular platform does not render any technical services to me. Nonetheless, there are views possible to say that depending upon how your agreement is structured, that it is a technical services or it is royalty and things like that. However, therefore, the moot question is, in a case like this, what do I look at first? Do I look at income tax or do I look at equalization levy? Because they are two mutually exclusive. One is under one law, the other is under the other law. The answer to that seems to be that I do have to look at equalization levy first. And why? Because section 1050 of the Income Tax Act says that, look, wherever equalization levy is leviable, you don't pay income tax to me. So therefore, I look at equalization levy. If it is payable, I enjoy an exemption at 1050. I don't look at Income Tax Act at all. So therefore, to my mind, the question is to see whether equalization levy applies. Then comes the question, will service of design and creating an ad attract equalization levy? So specified services is defined to mean any services for the purposes of online advertisement and includes etc. etc. So let's take an example that here this particular entity is designing and creating a film. So he's shooting a film, he's creating a, he's producing a film. That film will be put up on a digital media. However, what runs to what runs to my mind as a layman is that, look, I produce a film. It's not necessarily that that film will be put up on the digital media. I can put up that ad 30 seconds film on in a cinema hall, and that can be put up as an advertisement over there. I can put this film on a television and run the show over there and show the advertisement over there. Now, as we have seen, the cinematograph film or the exhibition in a cinema hall is not something coming within this purview of online advertisement. So there is no equalization levy over there. But then that film, I use it for digital media. You say that there is an equalization levy. How do I, at the stage when that film is produced, how do I find out as to where I will be using this film ultimately? So the question therefore is that under what circumstances this tax is leviable or this tax is not leviable? The answer to that is that the phrase for the purpose of, and the for the purpose of phrase looks at the proximate cause or proximate relationship between why that ad film is produced and what is the immediate cause. If it is established that I have appointed a person for shooting a film for showing into this in cinema hall or to show it on a traditional television, and therefore he has applied a particular technology and applied his particular equipments and shot that film in a particular manner so as to be suitable for that media, I buy that film from him, and thereafter I decide, okay, I also wanted to use it for digital media, so I put it on YouTube. Now, will that result in the levy of this equalization levy? And if the answer is yes, how will anyone monitor it? How will it be monitored? Impossible to monitor. So therefore, the legal answer to that is, what is the proximate cause? Have you commissioned the agreement between you and that producer of the film to produce something for digital media? Because I'm told that something which is produced for digital media has different characteristics. It can't be recharacterized, or it can't be repurposed to show it on a cinema hall or television. But something which is shot for cinema hall or television can be repurposed for the purposes of YouTube. So there is what is the proximate cause that one is, that is what I think one has to see. So the answer therefore is that if I have produced a film for showing in the cinema hall, which is based on a different technology, if I want to show it on a YouTube, there will have to be some sort of a repurposing happening to put it on a different media to show it, and therefore that some small little expenditure which I will have to do to convert it into that, to make it more appropriate for digital media, may qualify for equalization levy, but the production of film as such may not qualify for equalization levy at all. But as I said, the converse is not true. If I have commissioned that for the purpose of producing a film to be put on YouTube, then certainly it is a services rendered for for digital media, and therefore it's an online advertisement, services for online advertisement. So difficult aspects. These are the issues which will need going into the depth of the facts of each case and getting into the root of the matter to find out whether, and then applying this law and applying all these provisions and saying that, okay, what is the meaning of the word for the purposes of, and you apply these case laws which say for the purposes of would really take you to the proximate cause. It's going to be a huge task litigating these issues when it comes up, unless there are clarifications issued on this. Then other question is that there is an Indian company which has a foreign branch doing that business in foreign country, and it engages another foreign company which provides its online advertisement services to that foreign branch. So the question arises as to whether in a situation like this is the equalization levy EL1 getting triggered. And why the question arises? The question arises because this non-resident service provider is providing services to a resident entity. Answer is yes. EFCO is providing services to an Indian company which is a resident company. A foreign branch of an Indian company is also resident in India by definition of residence, and therefore there are services provided to a person resident in India. The services provided to a person resident in India, will this equalization levy apply? If you look at section 9, which talks about fees for technical services, it's very clearly mentioned that in a situation like this, where a foreign company is providing technical services to a foreign branch of an Indian company, then that technical services is used for the purpose of business outside India, and therefore 917 says that there is no tax in India, because there is no nexus in India. There is no economic nexus in India. That online advertisement is not used in India. It is used only by the foreign branch of the Indian company. So 917 is very clear on this. However, equalization levy does not have this clarity at all. And therefore, a possible view could be that in cases like this, equalization levy could get triggered, and therefore there would be litigations on that. So therefore you'll have to develop all arguments that section 163 of this chapter 8 says it extends to whole of India, and this advertisement is not rendered in India. Then you will have to get into all the historical documents as to what was the genesis of equalization levy. You see BEP section plan 1, and BEP section plan 1 really says that it really says that there should be a nexus. If you look at the committee report, BEP section plan 1 says that equalization levy would be intended to serve as a way to tax a non-resident enterprise's significant economic presence in the country. Is there a presence in the country? Answer is no. The committee report says that the services provided are either received, utilized, provided, or performed in India. Now, these services are not utilized, not received, not provided, not performed in India, and therefore, as per the committee report, also this was not intended to be taxed. But the way the section is worded, there's a difficulty. There's a footnote which is also there in committee's report. It says the nexus between the Indian jurisdiction and the taxpayer is proposed to be broadly similar to the royalty and FTS jurisdiction. And therefore, the royalty and FTS jurisdiction, as I say, section 917 says that if there is branch outside India to which the services are rendered, there is no tax in India. And therefore, these are the decisions which talk about extraterritorial application, and if there's an extraterritorial application, that law cannot be regarded as being applicable. So friends, these are only two illustrations of this levy. When we come to EL 2.0, there are a lot of other things to discuss, and the question is that now the question to be noted is that burden of equalization levy on an is essentially falling on whom? Although the charge is on the income of that foreigner, but the burden actually falls on the Indian person, because section 163(6)(3) says that if you do not deduct tax, then you have to pay from your own pocket. And if I have to pay from my own pocket, the question arises: is there any grossing up required? The answer is no, because in the Income Tax Act, when TDS is to be paid out of your own pocket of the deductor, there's a grossing up provision in 195A. Similar grossing up provision is not there in the equalization levy, and therefore there is no grossing up required. The question, there's also a question that in absence of the charge, so there is some service where there is no charge, okay, and if there is no charge, still there is a TDS requirement or not? Now this it does not sound to be a very intelligent question, but the reason why this question is raised is that in section 195 of the income tax, it says that a person paying to a non-resident will deduct tax at source on the income chargeable to tax. In it, therefore, there is no chargeable to tax, there is no TDS. Here, there is no such thing. that equalization levy chargeable to tax, that words are missing. But anyway, that's why the question is raised. But I do not think that there is any any way, that a person is required to deduct tax when there is no charge. When there is no charge, there is no question of TDS. Is equalization levy nothing but an additional cost to Indian businesses? Yes, it is nothing but an additional cost to the Indian entity. Possible grounds of criticism was only that equalization levy is an additional cost. But the interesting observations in the committee report is that, look, if it was fees for technical services, you would have deducted 10%, and therefore you would have borne more tax. Now here it's only 6%, and therefore it would be cheaper to you to pay this particular tax. So this was the justification given in the committee's report. The question arises as to what is the point of deduction of equalization levy, because here section 195 of the Income Tax Act says that when it is credited or paid, whichever is earlier. Now here there is no such saying that whether it is paid or credited or paid, whichever is earlier, that language is missing, and therefore the question arises: at what point of time do I make a payment? Well, at what point of time do I am I required to deduct this tax of equalization levy of 6%? So therefore, really the question is that if there is an advance payment, what happens? This point of time, the section says paid or payable. You're supposed to deduct equalization levy when it is paid or payable. What happens if I make an advance payment? Now, what is paid or payable? The equalization levy which is chargeable under 165 unpaid or payable. What is chargeable under 165? The consideration received or receivable for rendering those specified services is chargeable. Now, the consideration received or receivable, when is this consideration received or receivable accrues to that person? It really depends upon what is the contract. When the services are rendered, then it is receivable by him at that time. If it is receivable by him at that time, then it is payable by me at that time. And therefore, merely because I pay an advance does not mean that there is a tax levy of tax here, so long as the advance is a refundable advance. If it is a non-refundable advance, then the matter is over. Equalization levy deduction will have to happen. But if it is a refundable advance, then the tax deduction really arises only at the stage at which that advance is appropriated towards the levy, because it is at that point of time that there is a charge to tax, because it becomes received or receivable at that point of time. So when can the advance then be said to be payable? It is payable depending upon your contract. Advance payment, okay. Then these are all. Is my screen lost somewhere?
Yes, we can't see your screen.
Oh, I see.
You will share again.
Yeah, 1 minute.
Yes.
Yeah, I can see that. Okay. So point of deduction of equalization levy, paid or payable, we have dealt with it. That takes us to the most critical part, equalization 2.0. I suppose we have 20-25 minutes. Okay.
Yes, we
Yeah,
are
okay.
at 3:10 up to 3:30. Yes.
Okay, right. Okay. Now this is the levy which is expanding the scope, and as Mr. Akhilesh Ranjan mentioned in his interview, very wide scope has been introduced. And what is this all about? Here you have a non-resident, the green box that you see, e-commerce operator. This e-commerce operator is providing e-commerce supply of service. Let's call it ESS. On the right hand side box, I've defined it ESS. Non-resident e-commerce operator is providing ESS, e-commerce supply of services. To whom? To a buyer. And that buyer is paying consideration to that non-resident ECO, e-commerce operator, for such services. Here again, like your equalization levy 1.0, that e-commerce operator who is a non-resident, if he has a P in India, then this tax does not apply. And in case of a P in India, if the e-commerce supply is not effectively connected. So if he has a P and this is connected to the P, no tax. If he has no PE, then this tax applies. If he has a PE but this income is not connected with, then also this tax applies, because he does not pay income tax in that situation. Now here, fortunately, there is no tax deduction required by this buyer. The provision is that this e-commerce operator is supposed to pay 2% tax. He has to pay 2% tax. And this levy will not apply if it's an advertisement revenue which falls under that 6% criteria, and the sales turnover or gross receipts is less than 2 crores of rupees. This less than 2 crores of rupees per e-commerce operator per year. You have to see that 2 crores per operator per year. Now, in this case, who the buyer is? Interesting. A person resident in India, a non-resident in specified circumstances, and a person who buys goods or services using internet protocol address in India, IP address in India. So this is basically a user of e-commerce services in India. So if a non-resident is providing something for to a user of to a services in India, he is subjected to this 2% levy. What is the definition of e-commerce operator? A non-resident. E-commerce operator is a non-resident who owns, operates, and manages a digital or electronic facility or platform for online sale of goods or services. And what is this ESS? ESS is online sale of goods, online provision of services, or facility for online sale of goods or services. So therefore, companies like Amazon, etc., who provide this platform through which this online sale of goods or services happen, then they would be coming under this tax net. Now, what are the specified circumstances? Specified circumstances: sale of advertisement and sale of data. What does this mean? So, say for example, you have this e-commerce operator ECO, which is, say, Google US. The buyer over here is once again an American company, which is an American fashion brand. That fashion brand is actually putting up an advertisement on the on that Google network, and that advertisement is put such that it is targeted to an Indian customer or Indian person who use it in India. Then therefore, that person in India clicks. Based on that click, there's an advertising revenue which flows, and therefore, if there is a non-resident like that who is generating this advertisement revenue for Google, but that generation of advertisement revenue is because of a viewer in India, then that transaction comes within the scope of equalization levy. Now, this is the law. Several uncertainties as regards this law. What are these? There's no definition of online sale of goods and online sale of service. What do you mean by online sale of goods? If you look at Sale of Goods Act, the question arises that I can sell online only music or ebooks, but can I sell a television set on online? Because if I book a television set on Amazon.com, then I can book, but that Amazon.com will deliver it physically to me. So does it mean that this is an online sale of goods? It is an online booking, but does it amount to online sale of goods is a question to be answered. Extremely difficult question to answer, but if one had to therefore look at Sale of Goods Act. And the Sale of Goods Act really says that in section 19, it says that a contract becomes contract of sale when there's a property in the goods passes, and property in the goods will pass when it is intended to pass as per the agreement. And if there is nothing in the agreement, then the property in goods as per section 20, property in a specific goods in a deliverable state, when there's an unconditional sale, unconditional contract for sale passes when the contract is made. So therefore, I cannot necessarily say that the sale completes only when the delivery is given. A sale could be completed even when a contract is signed. So I place an order, that contract is agreed upon by both the parties, and that sale is effected even if the delivery has not happened. The question arises as to, can you say the same thing about services, online provision of services? So booking of air tickets is online. So question is that, yes, booking of air tickets is an online service, but the aircraft is not providing me an online service. Aircraft is providing me a service which is a physical service. So what is the subject matter of tax over here? The booking which has been done, or which is the online service which is service which is provided? So therefore questions will arise that 2% tax is on what? Is on the entire ticket amount, or it is only on the commission account? So on and so. So then, specified circumstances. We have seen what is the specified circumstances. Consideration. We will see this consideration, whether it is a whole amount or commission amount. We'll see it when we do the case studies. Certain other uncertainties. Sales turnover or gross receipts, 2 crore that we have said, 2 crore, how it is to be computed. There's an anomaly which has crept in. Exemption under section 1050 is applicable on or after 1st April 2021, but this levy is applicable for all transactions from 1st of April 2020, and therefore transactions facilitated or provided on or after 2021 April 21 seems to be a mistake in section 1050, and this needs to be corrected. Otherwise, what will happen is, today, as on today, both the laws are applicable: equalization levy, EL2, as well as your income tax. The question again arises as to what is sale of goods. What is goods? If I sell music, is it goods? If I sell e-books, is it goods? Is it required that that goods must be necessarily tangible goods? And the answer to that lies in the decision of Supreme Court in TCS case 271 ITR 401, that which clearly says that the property which is capable of being abstracted, consumed, used, transmitted, transferred, delivered, stored, or possessed is goods. The Indian law does not make a distinction between tangible and intangible, although English law may be making that distinction. In fact, English law has introduced a digital content. It says digital content is neither goods nor service, and they have therefore introduced a third category. But then India does not recognize that difference, and therefore, so far as India is concerned, your e-music or e-books or whatever you buy online is also considered as goods as per Supreme Court decision in TCS case. There are a host of other uncertainties, friends. We can go on and on forever. Like, say, for example, what happens is what is the scope? What is the scope of this particular levy? It is so huge, so wide. The questions have arisen as to whether there's a foreign bank And on that, I go onto the website of that foreign bank and I buy a travel card and I make a payment for the travel card. Questions arises as to whether that is an online service which is provided to me, and therefore that foreign bank is liable for equalization levy or here or not. Is that even intended? It's not really intended. And however, the way the things are worded, this is also something which can be brought within the purview of this particular levy, and therefore it is extremely important. And I think this will happen in terms of clarification as to the scope, clarification of the definitions of all these terms that we have seen is something which is indeed required very badly before this law is really implemented. There's one more aspect which needs to be noted, and that aspect is little scary. And what is it? There are several provisions in the Income Tax Act which have been introduced as part of this particular act, and says section 178, which says the several provisions. One of the things the section 178 says is that chapter 15, Roman 15 of the Income Tax Act shall apply to equalization levy. And what is this Roman 15? Liability in case of special cases. This chapter runs from section 159 onwards till section 180, and it therefore includes section 163, which talks about an agent of a non-resident. And it says that any resident through or from whom a non-resident earns income can be regarded as an agent of a non-resident. And therefore, if that chapter applies to equalization levy, the question, $1 million question arises as to whether that equalization levy, if it is not paid by that particular foreign entity, will the Indian user of that service be liable, will be regarded as an agent of a non-resident for being charged with that vicarious liability. To give a simple example, I have made a subscription of Netflix. Netflix does not pay equalization levy in India. Does it therefore mean that Yogesh Thar will be issued with a notice that why he should not be considered as an agent of a non-resident? Why should that 2% equalization levy on whatever subscription you have paid will be chargeable to tax? Should it not be charged to tax? A draconian provision. Silver lining here is that most of these companies do have Indian entities in India. And if at all there's a 163 proceedings, it will probably happen on those Indian companies of those foreign entities. However, it may be possible that some of them may not have, and therefore the user of the services may also be exposed to this particular draconian provision. So there are several other aspects of equalization levy, whether it is income tax or not. I may skip it for the want of time, and I may just mention here in slide 49 that the provisions have been so hurriedly enacted, friends, that you do not have a provision like 143.3 here at all. You have provisions like 143.1, summary adjustments, arithmetical accuracies, inaccuracies, etc. You have 154, you have interest, you have penalties. But there is no scrutiny assessment. So how do I create a demand? How is a demand created? If a demand is created, how do I pay it? How do I go into appeal? There are no provisions. I take a view that the non-resident entity ECO takes a view that this transaction is not subject to equalization levy. The assessing officer takes a view, no, this is subject to equalization levy. But there is no mechanism like 143.3 to make an assessment on him. All mechanisms which are there are only of the type of 143.1, 154, penalty, interest, appeal against penalty. There is nothing else. So how will this law be implemented is a $1 million question. So it has been introduced hurriedly, friends. On 23rd of March, this was introduced in the Finance Act 2020. At the time the bill became the act, it was not there at the bill stage. It has not been discussed by you and me when we discussed the budget, not at all. 23rd of March introduced, 27th of March passed, over. So This is where we are. It is a premature law and huge uncertainties, huge implications. One doesn't know whether I can go for advanced ruling in cases like equalization levy. There's only one way possibly, that there is an exemption in section 1050. Equalization levy provisions in the Income Tax Act are not made applicable to equalization levy. I mean, advanced ruling provisions are not made applicable to equalization levy, and therefore prima facie I cannot go for an advanced ruling. However, there is this section 1050 in the Income Tax Act which says that if there is equalization levy, you enjoy exemption. So I can possibly go to the advanced ruling authority and say that I'm entitled to this exemption or not, you tell me. And while deciding that question, it will have to decide whether or not equalization levy is leviable or not leviable. Then only whether or not exemption is applicable or not is a question. So therefore, friends, premature way, this particular law has been enacted. Finally, I mean, just take about 5 minutes. There are a lot of interesting case studies, but I don't think I'll have time for that. But one more aspect of this e-commerce transaction that we need to see is the introduction of 194O that was introduced in this Finance Bill 2020. And 194O is something like this. Now, this is a part of Income Tax Act. Equalization levy is finished. And there will be overlap between this 194O and equalization levy, and therefore those case studies are there. However, we may not have time for the case studies, but I try and explain certain things while I'm dealing with this particular slide before I call it. 194O is TDS on e-commerce transaction. Here also you have this concept of e-commerce operator. Here this e-commerce operator is a person like, say for example, I'm just giving example to save time and for all of us to understand rather than getting into the theory and definition. Say it is Book My Show. Book My Show is an operator. He facilitates, he owns or he runs or he manages an online platform, and from that online platform he facilitates a buyer of service to buy tickets. So if Yogesh Thar wants to buy a ticket for a show, for a cinema in Metro Cinema, he goes on to the Book My Show, buys a ticket, and based on that ticket, Metro Cinema, who is referred to here as e-commerce participant, exhibits that film, allows me that entry in the theater, and provides me that service. Here the question, or here the law requires, 194O requires that this participant's income, what he is going to earn from this transaction, should be subjected to 1% TDS. And who should be doing this TDS? The e-commerce operator, namely that Book My Show. He has to do this TDS of 1%. This TDS is on what? This TDS is supposed to be on the gross amount of sale or service. So on the gross amount of service, he has to deduct tax at source. He has of 1%. So take for example that I buy this ticket for 250 rupees. Book My Show takes its commission of 25 rupees. 225 rupees is paid to this Metro Cinema, and therefore out of this 225 rupees I am supposed to deduct 1% TDS. And therefore the question is, what do you mean by the gross amount of sale or service? This gross amount is 250 or is this gross amount 225? To cut the long story, I'm not getting into all the explanations for the time. To my mind, this 1% is on this given facts, it is on 250 because it's the gross amount of sale or services. Under certain other situations, the answer could be different. Then this TDS has to be done by the e-commerce operator. E-commerce operator could be a resident, he could be a non-resident. Now, if he is a resident or he is a non-resident, if he is a non-resident, therefore, you are imposing a liability or an obligation to do an Indian TDS by a non-resident. So it's like saying that when I in India make a payment to somebody in America, I should know his TDS laws and I should deduct his TDS as per the American law. Extremely wide in approach and extremely difficult for anyone to understand our Indian laws and deduct tax at source on 1% over there. Secondly, what is the purpose of this law? The purpose of this law, as is enacted, as is there in the explanatory memorandum, is to widen or deepen the tax net by bringing the e-commerce participant within the tax net. Now, friends, in our example, this e-commerce participant is who? Is Metro Cinema or it's Inox, who is a taxpayer in India. You don't have to get hold of him or widen your tax net to catch hold of. You have to widen your tax net to catch hold of small people. But the small people less than 5 lakhs, you have already exempted. And would those small people anyway be the people whose services or goods I will buy online? Answer is no. I am going to buy online some branded products, some big names or big things, and therefore these small players are anyway not there in this game at all. And therefore, what is the purpose which is going to be served by this enacting this particular provision? I do not know. That e-commerce participant, there is a small exemption. E-commerce participant is an individual or an HUF whose turnover is who's less than 5 lakhs of rupees. For that e-commerce operator, it is per e-commerce operator 5 lakh rupees per ECP. So e-commerce operator has to deduct, and he has to see how much business he is doing in a year with that participant. And based on that, if that business that he is doing with the participant is less than 5 lakh, then there is no TDS. And then if that e-commerce participant does not provide his TAN number, then PAN, then it's not 1%, it's 5%. So it's like 206AA type of a thing. The 206AA is 20%, here is 1% becomes 5%. So this is a law, friends. And there are lots of uncertainties into this provision. If I can spend 2 minutes on this slide and I'll not do the case studies. One, of course, is it says supply of goods or services over digital or electronic network. Now, supply of digital, so over digital or electronic network, is Metro Cinema exhibiting movie over digital network? Answer is no. So the language of the section is something which is difficult to understand, difficult to catch. Then gross amount. What is the gross amount is also an issue. Is commission paid to the ECO? Answer is yes, that is the commission which is the gross amount. Should GST be added? Yes, GST should be added. If the buyer of the service, buyer or the service recipient can be a resident or non-resident, we have talked about that. Then there could be overlap between 194O and other provisions. Would other provisions, like if there is a commission payment to that Book My Show, will 194H apply? Interestingly, here the subsection 3 of 194O says that no other when qua this transaction, no other tax TDS provision of the chapter will apply. So this is not qua the deductor or qua the person. For the transaction to which 194O applies, no other provision applies. Therefore, I will say 194H does not apply. So I will not deduct TDS in a case where the e-commerce operator is an Indian, is a resident. 194H does. What implications are there? Questions would arise as to whether sale of goods owned or the services owned by the ECO himself. So a seller of goods has its own website. Whether that sale happens to its own website, whether this provision will ever apply? Answer is no, because here the e-commerce operator and e-commerce participant are both one and the same person. If they are both one and the same person, the mechanism provided in the section fails, and therefore this particular provision fails. There is no 194O really applicable in that situation. So friends, we can go on and go on and on. We can have number of sessions of this, but this probably only has given you a bird's eye view of what these provisions are. What is the depth? What is the requirement globally of bringing about these provisions of separately charging the e-commerce transaction? The old concepts of permanent establishment are now giving way to the newer concepts. We have section 9, etc. There are some slides on that also, but we will not be dealing with that right now. So a provision of equalization levy, which was brought in as a temporary measure merely because globally there is no consensus as to how the e-commerce should be taxed world over. India says that I cannot fold my hands and just sit quietly. I have introduced equalization levy. I'm going to expand that. Let the world do whatever they want to do. This is my tax, independent of the tax treaty and independent of the income tax act. You pay me this over here, and if you don't pay me this, some tax will be advertisement tax will be borne by the Indian person. So far as the other tax is concerned, that 163 hanging sword is there on Indian residents. Otherwise there is no liability of the Indian resident so far as the EL 2.0 is concerned. And of course this 194O is there. So friends, all the three measures by the BEPS initiative, the equalization levy, the significant economic presence, and the tax deduction at source, all the three are brought into the statute by India. Significant economic presence has not been implemented. It may not be implemented so far, so long as there is a consensus all over the world. It is just a policy statement made by India to show to the world that this is the way it should be. Formula-based allocation of profits all over the place as to how you should be doing it, what weightage you should be giving to the users in India, what weightage should you be giving to the data that you have collected in India, so on and so forth. Okay, friends, thank you very much for the patient hearing. The time is running out. I couldn't do the case studies, but anyway, whatever I've covered, I hope you've enjoyed. Thank you so much.
Thank you, Yogesh Bhai, for the excellent presentation. You covered a wide range of issues throughout. We'll just wait for a few minutes for the questions to come in. We'll take a few questions. Mishra ji. Yogesh Bhai, can you read or?
I'll read.
Okay.
Payment made to Amazon Web Service, DigitalOcean.com, etc., for the use of its services in foreign currency, whether there should be any withholding tax or not by the company with respect to such payment. So, as I said, a very, very wide ranging question. The answers could depend upon various facts. If I am making payment to Amazon.com for purchasing a television set in India or purchasing music in India, it will depend upon whether it is Amazon.com or whether it is Amazon.in, whether it's an Indian company to whom I'm making payment or whether it's a non-resident to whom I'm making payment. So one cannot really have one answer to this question. It will depend. However, as I said, so far as these new levies are concerned, 194O is concerned, 194O envisages that there is a buyer, that there is a participant who sells something, and then there is an operator, and it is where that operator makes payment to the seller. 194O applies. So that is 194O is a tax on that participant's income, not a tax on the operator's income. Amazon will be an operator in this particular case. If you're making payment to Amazon.com, the tax deduction may be required only if it falls within the equalization levy framework of EL1, if it is relating to some advertisement which is hosted on their website, if it is relating to a purchase for which Amazon is supposed to pay equalization levy EL 2.0, there is no TDS requirement, fortunately, and therefore there is no requirement of tax. So as I said, answers could be various depending upon the facts. Okay. Second, whether payment made in a foreign currency by the director of a company by his credit card for such services which are utilized by the company and reimbursed to such director valid. Payments made in foreign currency by a director of a company by his credit card for such services which are utilized by the company and reimbursed to such director valid. Yeah, valid. I mean, somebody can incur expenses on behalf of the company. Company obviously incurs expenses through somebody, and that through somebody could be a director, could be an employee, could be anyone. And therefore, if it's an expenditure of the company, so what is important here is it the expenditure of the company? Whether such payments made by individual on behalf of the company liable for RBI regulations and the Form 15 CACV needs to be filed for the same or not. So any payment to a non-resident, 15 CACV requirement is under 195.6, and 195.6 would say that if a payment to a non-resident would be subjected to the requirement of 15 CACV, and if it doesn't fall within the exemptions which are given in your rule 37BB, then this requirement will arise. But so it really depends upon for what purpose is this payment made by that person to a non-resident. Equalization levy was levied for taxation on Google transaction. We checked the bill raised by Google. It contains GST charge on services. If GST is charged, it can be inferred that Google has presence in India, and accordingly, if tax is deducted in a 194C, would there be no need for equalization levy? Is my understanding correct or enlightened? No, here we are mixing up two issues. When there is a GST which is charged, it means that there is an entity in India who is providing the service. If it's an entity in India who is providing that service, then then there is no question of equalization levy on that transaction or on that amount. But there could be a transaction between that Indian entity and the foreign entity on which the equalization levy would come in under the EL2 provisions, where that EL2 will have to be paid. Now, if there is a 194C to be done for any work done by that entity, that 194C will have to be done independently of that, because here you are dealing with an Indian entity because he's charging you GST. Then EL applies to a payment made by a resident to a non-resident for business purposes of a resident. That is EL1, where whether EL will apply if, say, Section 8 company or a charity pays to, say, Facebook US for online advertisement of charities post-graduation scholarship loan program in the course of his charitable activity. So in the course of charitable activities, whether it is business or whether it is not business, is something which is subject matter of, once again, interpretation on the facts of the matter. So if it is the normal course of the charity to do a particular business activity, it may be possible that it is Section 8 and therefore it is exempt under 12AA read with 11. But nonetheless, it is business. So if that Section 11 exemption was not there, he would have paid tax as per the business income. And therefore, merely because it is exempt under Section 8, it does not enjoy exemption for equalization levy. Is there anything else?
I think these are all.
Okay.
If there was anything further, Mishra ji would have added.
Question, sir. Yes.
Okay, thank you, Mishra ji. ये बंद कर सकते हैं. I will request Vimal Agarwal. Vimal ji, if you can just switch on your camera also and join us on the screen, Vimal ji.
Thank you, Murtuja bhai. On behalf of WIRC, I would like to thank CA Yogesh Thar for accepting our invitation and taking session on subject equalization levy and e-commerce. I hope this session will definitely enhance our knowledge. Sir has covered the topic in very great depth. I also thank Central Council member CA Srinivas Joshi for giving his valuable guidance. I also thank Secretary WIRC Murtuja Kanjwala Regional Council Member Umesh Sharma, Regional Council Member CA Kamlesh Sabu, Regional Council Member CA Chintan Patel for taking lot of effort for this direct tax reference course. Thanks once again.
Thank you, Vimal ji. And thank you, Yogesh bhai, for joining us and sharing your knowledge with all the participants. We are extremely grateful on behalf of WRC. We thank you once again.
Thank you. My pleasure.
मिश्रा जी,
सर बोलिए।
ये स्क्रीन ब्लैंक हो गया है, क्यों? कुछ
नहीं जो दिख रहा है मुर्तुजा भाई।
ओके, गुड। सो
तो दुर्गे सर आ रहे हैं सर 2 मिनट।
ओके,
I think we can move on to the next session. Murtuza bhai.
actually
Let's,
just
we are waiting for Durgesh bhai, I think.
yes.
Okay, let him join.
Mr. Murtuza, I'll exit.
Yes, sir.
Yes,
You
Yogesh
may.
bhai. Yes.
You
Thank
may.
you.
Thank you so much. Thank you.
Thank you so much, sir.
I think Punjabi sir must take the entry in this.
Mhm.
Next speaker, sir. He is also there.
Yes. We request our speaker for the second session to also switch on his camera so that, sir, we can get you on the screen. Welcome, Jagdish ji. We can't hear you. Can you unmute yourself?
Good evening. Good evening.
Yes, good evening. Yes, welcome, sir.
Good evening and welcome, sir.
Very good evening to you.
Yes, sir.
So, while CA Durgesh Kabra joins in, I would request our regional council colleague, let me welcome both of them, CA Kamlesh Sabu and CA Chintan Patel. And let me also welcome today's learner speaker for the second session, CA Jagdish Punjabi. Kamlesh bhai, in the interest of time, you can give your views and also introduce a speaker. In the meanwhile, if Durgesh bhai joins in, then he can give his opening remarks and we can get started. So what do you,
Sure,
Kamlesh
sure.
bhai?
Thank you, Murtuza bhai. Thank you once again, Murtuza bhai. And on behalf of the entire West India Regional Council and all the participants, those who are attending this flagship event of our Regional Council, there is direct tax refresher course. And we have with us none other than today's speaker, C. Jagdish Punjabi, par excellence. And this is my what a great opportunity to me to introducing him. So I'm starting his introduction. And Mr. Jagdish Punjabi is a practicing chartered accountant and practicing in the area of direct taxation since 1989. He has secured a rank in CA inter examination and his practices in his individual name. He has been a lecturer in accountancy and taxation for a period of 17 years. He was head of department of the accountancy in St. Andrews College of Commerce and Economics, Bandra, Mumbai. He is contributed to the features tribunal news published in the Journal of Bombay Chartered Accountants Society. He is a member of various committees of BCAS and of the Chamber of Tax Consultants. He is a regular speaker at various seminars and he has also presented papers and authored various articles. He is also guest faculty at the training programs conducted by National Academy of Direct Taxes Nagpur and Direct Tax Regional Training Institute Mumbai. He is really such a versatile and knowledgeable person sitting in front of all of us, and this is really great opportunity to all of us to listen him and given taxation on all the real estate transaction or topic we had given to him. So now I think Murtuza bhai, you can take over for the few minutes till that our Durgesh bhai is joining. Thanks. Over
Thank
to you,
you.
Murtuza. Thank you so much.
Thank you, Kamlesh bhai. So there are only two announcements which I'd like to make. So for all the participants, friends, tomorrow we are starting a lecture series on the accounting standards. And it's going to be like tomorrow, Sunday, and then next Sunday, that way, Sunday after Sunday. 4 Sundays we are doing the accounting standards. And on Monday onwards, we are also starting a series on the GST, and that is 4 consecutive days for 3 hours each. So I would request whoever is interested to please register for both of these. And for accounting standards, I'm not very sure whether the registration might have closed or will close, but then still we can try and see how best we can manage. With that, I think I can check in a meanwhile, but in the interest of time, I think we'll start with the session. And so Jagdish, over to you, and you can start, sir.
Is my screen being shared?
Sir,
Is my
आ गए
screen
दुर्गेश सर आ गए yes sir
We can see this.
Sir, we'll interrupt for a
Okay,
minute. I
okay.
think Durgesh Kabra sir joined.
Yes.
For a
Yes,
minute.
sir. दुर्गेश भाई,
दुर्गेश जी, आपका वीडियो ऑन करो और म्यूट है ऑडियो.
I have unmuted but video on करिए ना आपके वहाँ से.
मिश्रा जी.
sir.
Who will on it? मिश्रा वीडियो ऑन करो ना.
हाँ सर, मैसेज आपको दे रहा हूँ सर, देखिए सेंड
अरे तू
वेबकैम
मैसेज दिया 2 बार, मैसेज आया, मैंने क्लिक भी किया, ओके. मैसेज देने की जरूरत ही नहीं पड़ती, होस्ट पोस्ट बना के डाल देता था, 1 मिनट में मैं क्लिक करता तो हो जाता था.
देखिए सर, अभी
कहाँ नहीं आया ना, अभी कोई मैसेज नहीं आया मुझे. नो मैसेज इज देयर. to share your webcam. तो बंद कर रखा.
Durgesh sir, we can hear you.
You can hear, definitely,
Yes,
but we cannot view. I don't know that he is not.
there might be some technical error. So requesting you to please.
Yeah, if you can speak, we can request you to.
Yeah.
Share my. No, I should click share my webcam, right?
Yes, sir. Yes, sir. Yes.
But I did that also, but it is not happening. It's not happening. I have got the message share my webcam. I clicked on it. It has gone, but it is not there. God knows what is happening.
Durgesh ji, yeah, you can. We can listen to you. So you can start your address, and in the meanwhile, let Mishra ji try it again to switch on your camera if possible.
I don't have any problem. You can you start the meeting and then what you want.
You can start with your. We request you to give your brief address to the participants.
Okay, fine. No problem. No problem.
Yeah.
No problem.
It is over to you, Durgesh bhai. You can start.
Thank you, Murtuja, the National Council member and secretary of WRC. Thanks to Chintan Patel, who is there, and the learned speaker Jagdish Punjabi, who is going to guide all the 2,500 plus participants of this direct tax refresher course organized by the WRC of ICI, a flagship program which is there, which is being conducted by this Western India Regional Council of ICAI always. And I'm sure that so far I think two sessions have taken place, and the members who are attending this particular webinar in the form of the digital learning, I think they all are enjoying the learning through the digital media. Thanks a lot to the WARC for giving me an opportunity to be a part of this particular session. Dear senior colleagues and professional brothers and sisters, I am having the proud to be a part of the Western India Regional Council. And today, when in this COVID and pandemic period, the Western India Regional Council has organized this webinar where ever highest number has gone. Normally, we are seeing the numbers of 1500 or so in physical presence, but here 2500 plus attendees are there. So I'm sure that the members are going to get benefit a lot. The number of more members are going to get the benefit of it more and more. Now, in the changing time and changing scenario, the chartered accountant fraternity is the fraternity who can learn the things very easily, because we are the people who learn the things constantly every year, whether it is a tax changes, whether it GST changes, whether the community law related changes. So we are in the continuous learning process, and when we are into the continuous learning process, what I feel that this particular pandemic period has also given us an opportunity to explore our lives and learnings in a different mode. And through the digital media, video conferencing way, we are learning and even we are earning. We can serve our time. We can build up our skill set. That is what we are doing. And that is why we are true partner in nation building. Friends and respected senior members, one most important thing which has started from 1st of July 2020, that is applicability of new code of ethics, which is there now, known as Code of Ethics 2019, which is mandatory for all of us. The new Code of Ethics based on the international standards of ISBA, International Ethical Standard Board of the IFED, and I'm sure that it is putting us at the international level. Our ethical standards, which are being pronounced, Code of Ethics, which is being pronounced, are of the international standards. Whatever kind of standards are being used by the other countries, other accounting bodies, other auditing bodies internationally, the Institute of Chartered Accountant of India is following now. So our ethical standards are at par with the international ethical standards. Though there are certain representations received there, and we feel that in this ethical code of ethics, 2-3 issues are of the concern, which we have thought of to postpone, and the council will be considering those. But in volume 2 of the Code of Ethics, the various amendments which have been done into the Code of Ethics, we have opened up various things with respect to the advertisement, with respect to the website, and other areas where the chartered accountants who are into the practice, who are partners in small and medium practicing firms, they will be benefited. Though there are in volume 1 some of the provisions which may create problem, so the council has decided with the wisdom that we are differing these 2-3 provisions, and we will be discussing again on what kind of changes are needed. We will consider those changes because we are not adopting 100% the ethical standards which are there internationally by the IFA, but we are converging the ethical standards issued by the ISBA of IFA. The way we have converged IFRS into the Ind AS, and we have converged even our standards on auditing as per the International Auditing and Assurance Standard Board of IFAC. So these standards have been prepared by SSG of ICAI and recommended to the Ministry of Corporate Affairs, and thereafter it has been notified and is now mandatory for all of us, the standards on audit. Likewise, the ethical standards are also mandatory as per the ICAI Act. So Code of Ethics has become mandatory. 3 provisions which have been deferred are with respect to 15% of the fees from one client. If you are receiving 15% or more fees from one client, it is required to be intimated to those charged with governance. This we have deferred for some time. We will deliberate again on this issue, and we will try to see that how the mix and match can be done and what is best suitable to the Indian practicing forms will be brought in the Code of Ethics. Second, with respect to the NOCLAR, which is non-compliance of laws and regulatory requirements, this is also newly added, which is internationally there in the ethical standards of the ISBA. However, it is there in SA 250, which is related to the compliance of the various law and regulations. Though it is already mandatory, but non-compliance, regulatory non-compliance of law and regulations required to be reported by us now, and we need to have all the basic knowledge, rather I would say reasonable knowledge of all the law and regulation applicable to the your client. We need to know all this, and accordingly, if there is any non-compliance, it is having the effect on your financial statement. You have to accordingly take care of those. But we have thought of that it is also required to be deliberated again, and we have deferred it for some time. The council will deliberate it again, and whatever is the best suitable to which kind of entity it should be first made applicable, and to which kind of entity it should be. So it will be done in a staggered way. The way the Companies Act has been made mandatory, the various provisions in 3-4 trenches have been made applicable. In the same way, these provisions of Code of Ethics will also be made applicable, and how it will be dealt with the different kind of your clients, it will be done. And the third one is with respect to the tax services to the audit client, where there is ambiguity, which kind of tax services can be done, which kind of tax services cannot be done, how it will provoke the self-review threat, advocacy threat under the Code of Ethics, and independence. All these things has to be understood properly. So, looking to all these things, the tax services to audit client have also been deferred for some times, and we will deliberate it again that which to which kind, whether it public interest entity or some other entities, where or some particular turnover, we will discuss and come back again, and we'll make these suitably amended and applicable to the various small medium practitioners and all other practitioners in the country. I'm sure that the concern areas were these 3, where we have got various feedback from the members at large, from the from across the country and from the region, and we have thought of that when we discuss about all these things, and we deliberate on this, and we bring it back to you in a different form, So it will help the small and medium practitioners. So my request to all of you that there is lot of seminar being organized by the various program organizing unit on this code of ethics. All the members are requested to please join all those webinars and virtual meetings which are there by the which is known as virtual CP meeting nowadays. So please do attend that, have a knowledge of the new code of ethics, and accordingly perform your professional well-doings. So, and one other things which I would like to bring to your notices, and which is important, that the institute spreading the knowledge through the various webinar is being taken up by the various branches when it has been said by the institute or by the ethical standard board. But simultaneously what we have done is we have put the material, videos and audios on the digital learning hub of the ICAI, where you can view the material, you can listen the material on the code of ethics, which is of 30 hours or so. You will get the 30 hours of structured CP credit also when you register, and it is free of cost. There are no charges. Simultaneously, there are various video lectures of the standards on audit have been uploaded on the digital learning hub, which is again giving the structured CP hours to all of you. And one more thing, very recently, day before yesterday, we have uploaded, being the member of AASB, I must tell you, and part of the publications on the CARO, the guidance note on CARO, video on CARO, audio on CARO, and resource material on CARO 2020 has been uploaded on the digital learning hub, which you can go through, which you can listen and see, and simultaneously you can also get 6 hours of CP learning, structured CP learning, that too also without any charges. So the institute is trying to give the best in this testing time. It is affecting all of us, and with this I would like to conclude, because it is better to listen on the subject. All these updates you can get from all other members also sometimes, and through the various notification on WhatsApp which you are receiving, you can get all these things. But since Jagdish Punjabi ji is there, who is going to guide you all on the taxation matters which are related to the real estate and real estate development also, and he's master of the subject. I have also listened him at once or twice. So I think he will add a lot of value to your knowledge into it. With this, I thank you all for giving me a patient listening, and I hand it over to the coordinators of this direct tax refresher course. And thanks a lot once again.
Thank you, Durgesh ji, for your updates on the happenings at the Ethical Standard Board, and also on all the inputs that you've taken on the 3 points and which members had concerns on, and informing the members that you're working on at the council on this. Thank you very much for that, and thank you for joining us. With that, we are ready to go straight into a technical topic. And since Kamlesh Bhai has already introduced the speaker, Jagdish ji, over to you, and your slides can also be seen, and please get started, Jagdish ji.
Thank you. Thank you, Durgesh, for your kind words. Thank you for the compliments. Good evening to the members on the dais, a virtual dais, may I say so, Kamlesh ji, Murtuza ji, and Chintal. The topic for this evening is taxation of real estate transactions. Now, while the term real estate is something which goes with builders developers, I was also told that I must deal with transactions in immovable properties held as capital assets by the investors or by the common man. That means we must even touch upon the transactions which affect non-builders or non-developers or other people who are not into real estate trade as a part of their business or an organized activity. Now, what we have planned is to have the session in 3 parts, or rather divide the topic in 3 parts. I mean, the talk in 3 parts. The first part dealing with issues which would be relevant to the real estate trade proper, that is issues dealing with builders, developers. The second part will deal with some of the issues which concern real estate held as a capital asset. And the third part will deliberate upon some of the issues arising as a result of COVID-19, how taxation of certain transactions and what are the hiccups which we are likely to face in view of the current environment which we are facing. Now, all through the talk, the endeavor would be to deal with the recent developments. Recent development would mean either the assessments ongoing or where appeals are pending at CIT appeal level, etc. The first couple of slides give you details of the amendments which have been carried out in the recent past and with the date of their respective amendment coming into force. So you can go through those slides at leisure. The slides are there with you. Now we come to the first topic, which is taxability of annual value of property held as stock in trade. Now a common issue has arisen. Builders are saddled with stock. The stock is not being sold, but at the same time, the tax department attempts to tax the notional annual value in respect of unsold inventory, which is not even let out. Now, department is trying to invoke the provisions of section 23. Now, before we come to the computation provision, that is the computation of annual value, let us look at the charging provision. The charging provision for the head income from house property is section 22. It charges to tax annual value of a property being buildings or lands appertaining thereto. Please pay attention. The charging section uses plural form, buildings or lands appertaining thereto. It is not a singular form. The charging section tells me that if I am the owner of a property and the property consists of buildings or lands appertaining thereto, and the property is not occupied by me for the purpose of my business or profession. So if all these three conditions are cumulatively satisfied, section 22 says that the annual value of the property shall be chargeable to tax. How to compute annual value is given in section 23. 23(1) tells me by and large it is the actual rent received or the rent earning capacity, whichever is greater, subject to clause C of subsection 1 of section 23. Now, come Finance Act 2017, effective assessment year 18-19, subsection 5 has been introduced in section 23. What does this subsection 5 now tell me? It says, look here, if you are owner of a property consisting of building or land appertaining thereto, and such property is held by you as stock in trade, and the property or part of the property is not let out during the whole year or part of the previous year, then annual value of such property for a period of 1 year from the end of the financial year in which the completion certificate has been issued shall be taken to be nil. Apparently, it looks like a provision granting some relief, some concession to a person. Is that really so? Possibly not. This provision is now being used to explain that the intention of the legislature always was that the annual value of stock in trade be charged to tax under the head income from house property. Therefore, the real question which we are addressing is whether annual value of property held as stock in trade is chargeable to tax as income from house property, or is it that the income therefrom, if any, will be considered under the head income from business. So there has been a controversy since long time about the head of income under which rental income is to be taxed. But now we are today, for the moment, discussing rental income qua stock in trade. We are not discussing rental income qua the flats held by an investor or flats or property, immovable property held as capital asset. Now, way back in 2007, Gujarat High Court in Neha Builders told us that if you let out your stock in trade, any income which arises from stock in trade is to be taxed under the head income from business. Therefore, the chapter on house property will be out as far as stock in trade is concerned. Now, then you have in 2015, Supreme Court telling you in Chennai Properties and Investments that if you are holding property with an intention of letting it out, if you have acquired or constructed property with an intention of letting it out, and in the facts before the Supreme Court, that was the only source of income of the SSC, Supreme Court said nothing doing. I mean, what is this? This is nothing but income from business. Therefore, Supreme Court said you don't have to tax rental income under the head house property. You need to tax it under the head income from business. The Rayala Corporation, second Supreme Court decision, just 1 year later, follows Chennai Properties. Once again, by and large, tells me that if your intention is to let out property and your substantial income is by way of letting out, then the rental income needs to be taxed as income from business. Now, mind you, they were not even dealing with items which were stock in trade. Chennai Properties was not dealing with an asset which was held by the SSC as stock in trade. I am now discussing that what happens if it was stock in trade. Even where it was not stock in trade, Supreme Court tells me that it needs to be taxed under the head profits and gains of business. Then you have Bombay High Court very recently in Classic Associates telling you that it needs to be taxed under the head income from business. But on the other hand, you do have decisions telling you that rental income needs to be taxed under the head income from house property. So what if you have held it as stock in trade? Now, our jurisdictional high court in Sane and Doshi's case held that rental income needs to be taxed under the head income from house property. The SSC there wanted the house property. Now, against this decision of the Bombay High Court, department is in appeal. Department has preferred an SLP. SLP has been granted. The department's contention is that since it was stock in trade, it should have been taxed under the head income from business. Now, there is some confusion on the field that the decision of Supreme Court in Raj Dadarkar and Associates holds that rental income is to be taxed under the head income from house property. The contention of the revenue is that, look here, Raj Dadarkar is way after Chennai Properties and Rayala. Therefore, Raj Dadarkar holds the field, and Raj Dadarkar tells me that income by way of rental income is to be taxed under the head income from house property. Now, it is incorrect to say that Raj Dadarkar is contrary to Chennai Properties or that Raj Dadarkar has taken a view or has overruled the decision of the Supreme Court in Chennai Properties. The facts in Raj Dadarkar were totally different. It was the SSC, Supreme Court said that the SSC has not demonstrated before the tribunal that it was carrying on complex commercial activities. It was a partnership firm. The SSC only showed a clause in the partnership deed saying that letting out is one of its objects of business. Supreme Court says merely showing us the clause in the partnership deed does not mean that the rental income needs to be taxed under the head income from business. You have to establish what are the nature of your activities, what is your conduct, etc. Now, as I mentioned, now we were up till now dealing with a case where all these cases were cases where the SSC at least received rental income. What we are now facing on the field is that the flats are vacant, they are not even let out, and the revenue is trying to tax the rent earning capacity or the annual value, so to say, under the head income from house property. It is possible that one may say that, look here, Chennai Properties was dealing with a case where the object of the SSC was to acquire or construct and let out the properties. Therefore, Chennai Properties may apply to such type of cases. But what happens where your object clause is to construct and sell, your object is not letting out, then I would feel there could be some difficulty. But as I said, all these are cases, or what we are now discussing first is the cases where rental income has been earned. Now, it was only in such cases, the only difference is whether I tax it under the head house property or I tax it under the head income from business. There may be some difference as far as allowability of certain expenses are concerned, as far as set off of losses, etc. are concerned. But nevertheless, I am asked to pay tax having earned the income. It's a matter of some computation, some deduction here and there. Whereas what I'm now discussing is that if the property is not let out at all, is the annual value thereof chargeable to tax? Now, before we proceed to that area, let's make a note of the Bombay High Court decision in E-City project construction, where Bombay High Court, having considered all the three Supreme Court decisions pronounced, namely Chennai Properties, Rayala Corporation, and Raj Dadarkar, held that the rental income is chargeable to tax in the facts of that case under the head profits and gains of business. Therefore, all that I'm trying to point out is that it's not an open and shut case. Now, to my mind, whether a property is let out or the property is vacant, the head of income will not change. If I let out property, stock in trade, and you come to a conclusion that the rental income is chargeable under the head income from business, then a vacant property, one cannot take a view that annual value will be chargeable under the head income from house property. If we take up a position that, or if we come to a conclusion that the annual value of stock in trade, the rent earning capacity of stock in trade is to be taxed, then the consequence will be that whether it is vacant or it is let out, the tax will be under the head income from house property. Whereas if we come to a conclusion that the tax has to happen under the head income from business on the ground that it is stock in trade which has been held, and one may take up a position that stock in trade is occupied by the SSE for the purposes of his business. Now, this entire controversy on taxation of notional annual value of vacant properties arose because of the Delhi High Court decision in Ansal Housing Finance. It was in Ansal Housing Finance that the Delhi High Court for the first time said that annual value of stock in trade which has not been let out is chargeable to tax under the head income from house property. The revenue preferred the SSE filed an SLP. The SLP was admitted but now has been dismissed on account of low tax effect. Now, the decision of the Delhi High Court was that the annual value of vacant unsold property held by the SSE as stock in trade is to be charged to tax under the head income from house property. Delhi High Court went by the exclusion of section 22. They said the SSE tried to argue, look here, what I have is stock in trade, and stock in trade is occupied by me for the purpose of my business, profits of which are chargeable to tax, and therefore annual value of stock in trade cannot be charged to tax under the head income from house property. Delhi High Court did not find merit in the argument. Delhi High Court said that occupied here does not mean physical possession. Occupied here in section 22 means used for the purpose of business. So if you have used property for the purpose of business, you will be out of the head income from house property. But as long as you are the owner and you are not using the property, so to say, according to Delhi High Court, you have not occupied it for the purpose of business. Respectfully, I may submit that the Delhi High Court does not consider the decision of Gujarat High Court in Neha Builders, the decision of Odisha High Court in MP Bazaars, and moreover, the decision does not consider the Delhi full bench in Modi Industries, where the Delhi full bench examined the meaning of the phrase occupied for the purpose of business. Therefore, to my mind, Ansal requires a review. Now, following the same, in the subsequent years, the SSE tried to argue after Chennai Properties came that, look here, sir, now I'm covered squarely by the decision of Chennai Properties. What went against the SSE in the subsequent year is that Delhi High Court said, hey, look here, last time when you were arguing for an earlier assessment year and we decided the matter against you, you tried to say that I have never let out the properties. It is not my intention to let out the properties. I am constructing the flats with an intention to sell them. Just because I could not sell them, I've held them. So today, just because Chennai Properties has held that if your intention is to let it out, you cannot come and say these are held for the purpose of letting. So on that count, the argument was not accepted. Then in the third year, again, the SSC tried to argue, take up a new argument. The SSC said, look here, sir, we have 23(1)(c). 23(1)(c) says that if the property is vacant for whole or part of the year, then its annual value shall be regarded as nil or proportionately. So if the property is vacant for the full year, you take annual value nil under 23(1)(c). This contention also was rejected by the Delhi High Court. SLP against every decision of the Delhi High Court in the case of Ansal has been admitted. Now we come to the scenario that what is the position before 23(5) came on the statute? What have the tribunals said? It appears that the tribunals have consistently applied the decision of Chennai Properties and held that where an SSC is holding property as stock in trade and such property is vacant throughout the year, its notional annual value cannot be brought to tax under the head income from house property. That's the ratio of decisions of the Mumbai bench of tribunal in CR Developments, Kumar Behari Rathi and Shri Balaji Ventures. Now, some of the tribunals say that yes, we are faced with a situation where we have Gujarat High Court telling us that the income from stock in trade is always to be taxed as income from business. We have Delhi High Court telling us that annual value of stock in trade which was not let out needs to be taxed notionally under the head income from house property. So we have two high courts, both of them are non-jurisdictional high courts. Therefore, following the ratio of the apex court in vegetable products, they say the view in favor of SSC needs to be taken, and the tribunals have been following the ratio of Gujarat High Court and coming to a conclusion that the annual value of vacant unsold inventory is not chargeable to tax under the head income from house property. In one or two cases, the revenue tried to argue that look here, sir, you have Bombay High Court in Sane and Doshi telling you that the rental income units held as stock in trade is to be taxed under the head income from house property. So vacant flats also income will have to be taxed under the head income from house property itself. How can you then say that since this is stock in trade, it will go under the head income from business? The tribunal says, wait, what is it? They say Sane and Doshi was dealing with a case where property was actually let out, whereas we are now dealing with a case where property has not been let out. So that is a distinction between the ratio of Bombay High Court and the facts before us. And since in the facts before us, the property has not been let out, the ratio of Sane and Doshi will not apply. I mean, that's the view tribunals have taken. Now a question arises that 23(5) has been introduced effective assessment year 1890. Therefore, question arises whether is it prospective or is it retrospective? Assuming it is prospective, does the introduction of 23(5) adversely affect the earlier years or the matters which are pending at appellate forums or where assessments are going on? We have Delhi High Court in Ansal itself and Kumar Behari Rathi Bombay Tribunal as also Opera Realty, and we also have Chennai Tribunal in Suryavardhan Estates, all telling us unequivocally that the provisions of 23(5) are prospective. Prospective, fine, but my question is that yes, 23(5) applies effective assessment year 1890, but qua earlier years, does the presence of 23(5) effective assessment year 1819 affect my case adversely as far as earlier years are concerned? Possibly. To me, it appears that the tribunals and the courts are taking a view that since effective year assessment year 1819 legislature has now told me that for a period of 1 year from the end of the year in which you get CC, annual value will be nil. Therefore, for all other years, you are liable to pay tax on the notional annual value under the head income from house property. Now, is this correct? Now, all these observations in all these cases have been by way of obiter dicta. Courts have never had an occasion to examine the provisions of 23(5) by way of a ratio decidendi. What do I mean by that? These remarks of the courts and the tribunals were, by the way, they were not really required to decide the case which the courts were then deciding. The point to be decided is that by amending a computation section and leaving the charging section as is it, have I successfully created a new charge, or is it that the legislature is telling me that charge always existed? Now I'm giving you a concession. I'm telling you, look here, sir, for a period of 1 year from the end of the year in which completion certificate is granted, I'm not going to tax you annual value. Thereafter, you give your flats on rent or your stock in trade as rent, and or you sell it, and therefore what I'm doing is I'm giving you a time period of 1 year to actually start earning or start disposing of your stock in trade. Now, Delhi High Court has also made observations, and it says that the court they have noted that 23(5) has been introduced, but they say the amendment is prospective. But they say that since a separate subsection has been inserted in 23, it is clear that legislative intent is that a peculiar situation in subsection 5 was not already covered by subsection 3. Correct, it was not already covered by subsection 3, but was it covered by subsection 2 by section 22 so as to trigger a charge? To my mind, the answer to that will depend on whether I can successfully contend that the stock in trade held by me is occupied by me for the purpose of business, and if it can succeed in arguing that the stock in trade is held by me as an owner for the purpose of business and I am occupying it for the purpose of my business, then the charge will fail. You have Bombay Tribunal in Oberoi Realty telling you that 23(5) is an incentive provision. It is a relief given to the real estate sector as such. Now, interestingly, Pune Tribunal in Balaji Ventures examines 23(5) or the tax of with reference to section 5, and it says that, look here, your section 5 deals with scope of total income. It taxes either income accruing or income received. A vacant flat or a vacant unit held as stock in trade, neither is income received nor is it deemed to be received, neither does any income accrue to a person. Therefore, I am out of section 5, and since I am out of section 5, the charge does not trigger there is no question of the annual value of stock in trade being charged to tax. To my mind, if I presume that I'm holding an immovable property not as stock in trade but as capital asset or as an investment, and I'm holding it vacant, I have say 4 or 5 properties, right? I always invest my savings in real estate, so I have 4 or 5 properties. Will you tell me that for the 3 or 4 properties which are vacant throughout the year, we are not going to tax the annual value because section 5, going by section 5, the income neither accrues nor is it received? Now, here in these 2 slides or 3 slides, I've listed down series of decisions of Mumbai Tribunal where consistently it has been held that annual value of stock in trade which is lying vacant cannot be charged to tax. By and large, they are Mumbai and Pune bench of tribunal. You do have decisions of Jaipur and Delhi bench as well. With this, I come to the next section affecting the real estate trade as such, which is section 43 CA. Now, 43 CA, as you know, is something akin to 50C. 43CA applies qua property being land or building or both held as stock in trade. So when a property being land or building, when an asset being land or building or both is transferred for a consideration lower than stamp duty value, 43CA tells me that I shall regard stamp duty value to be the full value of consideration for the purpose of computing profits and gains from transfer of such an asset. Now, whether 43CA is under the head income from business, it's a separate issue that under the head income from business, I never compute profits and gains from transfer of an asset. I always compute profits and gains of my business. I do not compute profits but nevertheless, I mean, maybe it's a badly drafted section. Now the section has come into force effective assessment year 14-15. Now, what is covered is only land or building or both. The part of the building is not covered. Therefore, a question arises, can I contend that a flat is part of the building and not a building? Therefore, 43CA will not apply when I transfer a flat in a building. 43CA may apply when I transfer a bungalow, but I'm just debating whether can I take up a contention that 43CA will not apply to part of a building, transfer of part of a building. Now, someone may say, hey, whole includes part. So if you transfer whole and the provision applies, if you transfer part of a building also, the provision applies. I mean, that's a settled principle. So why do you need to discuss and why are you raising this? I'm raising this because there are several sections in the Act, some of them introduced very recently also, such as section 27, 194 IA, LA, LAA, and 269 AB, all making a specific reference to part of a building. If whole always included part, why does legislature in these 5 or 7 sections mention part of a building separately? Second, I mean, this is one argument. However, I would believe the similar is the language in 50C. 50C also does not use part of the building, but the controversy, 50C has been on the statute since assessment year 2003-4 over a period of 16-17 years. I don't think anybody has contested that the provisions of 50C will not apply when I transfer part of a building. Also, the decisions rendered in the context of section 54, where an assessee purchases not a full house but a part of the house, courts have taken a view that even if I purchase a part of the house, it is akin to purchasing a house, and exemption has been granted. Now those decisions, one of them being Gujarat High Court in Chandanben Mangalnath's case, will be the decisions revenue will argue in its favor. Even personally, I would take up a view that whole includes part, and therefore part of the provisions of 43CA will apply to transfer of part of a building as well. Now, is building under construction covered? The answer would be no. Punjab Haryana High Court in the context of wealth tax in Nina Jain's case held that a building under construction does not fall either within the definition of building nor does it fall within the definition of urban land. So if on a plot of land you have a building under construction and you transfer the building under construction, such a building under construction cannot qualify either as land or as building. Now the next question arises whether the provisions of 43CA will apply only to land or building, or will it also apply to rights in land or building? For example, if I transfer leasehold rights in a building, I'm not transferring the building, I'm granting a lease. I'm granting lease of a land. Will the provisions of 43CA apply or will they not apply? Now the language of 43CA is pari materia to the language of 50C. Therefore, I would believe that the ratio of all the decisions rendered in the context of 50C should with equal force apply to 43CA as well. And in the context of 50C, we have Ahmedabad Tribunal, Yasin Musa Goril telling us that 50C does not apply to rights and bidding. In that case, the tribunal was dealing with transfer of booking rights. We have series of decisions telling us transfer of leasehold rights does not apply. Provisions of 50C. For land development rights also, we have Mumbai Tribunal in Voltas Limited telling us that when you grant development rights, provisions of 50C do not apply. Prior to Voltas, we have Mumbai Tribunal in Chiranjeev Lal Khanna, Arlette Rodrigues, and Rital D'Souza telling us that 50C does apply to transfer of development rights. In the case of Chiranjeev Lal Khanna, tribunal, while coming to the conclusion, has examined in detail the definition of transfer. The issue to my mind should have been whether nobody is disputing that granting development rights amounts to a transfer. What I'm asking, the issue being raised or which needs consideration of the judicial forums is whether development rights is covered by the term land or building or both. Certainly not building. So when I transfer development rights, can you say that transfer of development rights amounts to transfer of land as stated in 43CA or 50C? You have Mumbai Tribunal in Atul Puranik. Against Atul Puranik's decision, the revenue chose not to file an appeal to the High Court. Now, you have Bombay High Court in Greenfield Hotels dismissing or not admitting the appeal. Now, what was the ground? It seems that in Greenfields, the tribunal followed Atul Puranik. So the court asked the revenue that, look here, tribunal has followed Atul Puranik. Against the order of Atul Puranik, you are not in appeal to the High Court. So what is your grievance now? What wrong has the tribunal done if it has followed its earlier decision in Atul Puranik? So on that ground, the Bombay High Court did not admit the appeal of the revenue. Now, in Hitex products also, the similar issue arose and the appeal was not admitted. You have, but now I would suggest that before taking a view that the provisions of 50C and or 43CA do not apply to transfer of rights in land or building or both, one needs to be aware of a couple of decisions which I am now dealing and then take a decision whether one really needs, what view one needs to take. In the case of Cancast Private Limited, the question of law as to whether 50C will apply to transfer of leasehold rights has been admitted. And Bombay High Court says that when revenue came before us in Greenfield or Hitex, it did not point out earlier decision of the Bombay High Court in Pradeep Steel the rolling mills. Had this been brought to our notice, our answer may have been different. Therefore, with that reasoning, Bombay High Court admits the appeal in Cancast. Now, in Keki Dadi said a reopening notice was issued on the ground that the stamp duty value is more than the agreement value. And what was transferred by the SSC was leasehold rights. So SSC said, where is the question of reopening? Because 50C anyway does not apply to rights in land or building. Here again, please make a note, Bombay High Court allowed, did not strike down the notice issue. Therefore, again, leaving some doubt, you have Rajasthan High Court in Ramji Lal Mina's case, take very clearly saying, very categorically saying that it does not agree with the decision of the Bombay High Court in Greenfield's case. Therefore, it's not a clear-cut case that whether these provisions will apply or will not apply. Now, here is a decision of Bombay High Court in the case of Jai Hind Siaki Limited, which was rendered in the context of wealth tax. Now, as you may be knowing that in the past, closely held companies were liable to pay wealth tax by virtue of Section 40 of the Finance Act of 1983. And one of the assets there on which wealth tax was payable was land other than agricultural land. In this case, SSC had taken a plot of land on lease from MIDC. Therefore, the SSC said, what I own is not land, what I own is leasehold interest in the land, and therefore I am not liable to pay wealth tax. The Bombay High Court did not agree with the contention. The question of law for consideration of the court was whether the expression land will include any interest in land also. Now, having considered these decisions, one will have to take a call as to whether what view one needs to take as to applicability of 50C or 43CA to transfer of rights in land or building or both. Now, since we are dealing with stock in trade, the transfer, the 43CA will trigger only if there is a transfer. Now, section 247, clause 47 gives me a definition of transfer, but that definition is applicable only to capital assets. The definition of transfer given in 247 does not apply to stock in trade. As far as stock in trade is concerned, the title gets transferred only when a conveyance is executed. Not only conveyance is executed, it should even be registered. Without that, there cannot be a transfer of title in an immovable property. And Gujarat High Court, way back in 133 ITR, tells us that transfer of stock in trade happens only when title is transferred to the buyer. Till such time as the title is not transferred, what you have received constitutes only an advance. And assuming you have even handed over the possession in part performance of a contract, Gujarat High Court says that may be a good defense to the buyer against the seller. It does not confer any title to the buyer. Now, if there is no transfer, the question of 43CA triggering does not arise. To the similar effect, as the ratio of Gujarat High Court in Ashaland are the decisions of Madras High Court in Chidambaram Chettiar's case, Gujarat High Court once again in Motilal Patel, and Andhra Pradesh High Court in Mughal Builders. Now, all these decisions, the root would be the decision of the Supreme Court in Alapatti Venkatramaya's case in 57 ITR 185. However, we need to keep in mind that our own High Court in Estate Investment Company's case has held that if you have done all that you were required to do, then the transfer has taken place. The court did not accept the contention of the SSC that until conveyance is executed, the purchaser cannot be regarded as the owner of the property. The court said, look here, you have done everything which is within your power to carry out your obligation with the purchaser. You have given the possession, price has been received. So why do you say that there is no transfer, and why do you don't want to offer profits for taxation? However, here one will have to keep in mind that the peculiar facts were that the SSC himself recognized the profits in the P&L account, carried them to the reserve fund, and in fact even declared dividend out of that. So, I mean, these were the facts which probably could have weighed with the Bombay High Court. Now, for a transfer to happen, the asset has to be in existence. This proposition comes out from Section 5 of the Transfer of Property Act. Therefore, what is not in existence cannot be transferred. Therefore, if I go and sell a flat under construction and the agreement therefore is registered, question arises, have I transferred a building? The answer is no. For a building to be transferred, the building first needs to be there. There is no such building today. The building is under construction. Therefore, what is this registered document? This registered document is just giving me a right to specifically enforce the contract upon the property coming into existence. The transfer in law will be a contract to transfer after the vendor has acquired the title, and that obligation would fasten upon the vendor as soon as the vendor acquires it. Transfer of a non-existent or what is commonly known as after acquired property is not of the nature contemplated in section 6(1). Therefore, to conclude, the provisions of 43CA may not apply to a flat under construction. However, upon the flat coming into existence, the applicability of 43CA will need to be examined. Now, as I mentioned, 43CA is effective from assessment year 14-15. Is it prospective or is it retrospective? The answer is it is clearly prospective. Nobody says it is retrospective. But the question is, when you say it is prospective, are you saying that 43CA will apply what transfers on or after 1/4/13, or will it apply to agreements entered into on or after 1/4/13? Possible that before 1/4/13, I have entered into an agreement to sell a flat to you. When I entered into that agreement, 43CA was not on the statute. I have not offered profits for taxation for that agreement. Why? Because the transfer has effectively not happened. Maybe I had done bookings of the flats. I had issued allotment letters. Now, as you are aware, subsection 3 and 4 of 43CA provide that if before the transfer happens, before the date of registration, there was an agreement to transfer, and under that agreement some amount was received by check, then the stamp duty value on the date of agreement will be considered and not the stamp duty value on the date of registration. Fair enough. Therefore, the question is the charge under is the computation mechanism under 43CA triggered only qua transfers happening on or after 1/4/13, or it is triggered if the agreement is entered into on or after 1/4/13? One more thing, as I mentioned, that you must have received some money before or at the time of execution of the agreement by check. Therefore, receiving amount in cash will not entitle you to go back to the date of agreement and claim the benefit of stamp duty value as on the date of the agreement. Therefore, the question is, to which situations, when I say prospective, what exactly do I mean? To my mind, the correct view should be, or the better view appears to be, that the provisions are effective in respect of agreements entered on or after 1/4/13. Qua an agreement which is entered before 1/4/13, even if the amount, the profits are offered subsequently, to my mind 43CA should not apply. However, please make a note that 3 tribunals have taken a view contrary to what I am saying. Therefore, the tribunals here are saying that if in the year in which you have recognized profits, 43CA applies, they say that yes, 43CA will trigger. At best, if you have entered into an agreement in 2010, we will consider stamp duty value of 2010. Then the question arises, hey, wait, in 2010, you did not tell me that I must not accept the token money in cash. I have accepted token money in cash. Are you saying that you will now not give me the benefit of even 2010 valuation? The tribunal says, no. Since you were not aware then that you need to accept the initial amount only by check or by banking channels, the provisions of subsection 3 and 4 will be effective only for transactions entered into on or after 1/4/2013. So for earlier transactions, the tribunal is saying it will not read that condition in. To my mind, the correct way or the better way appears to be to say that 43CA will not apply in all cases where there is an agreement entered into on a date before the provisions were enacted. Now, in the case of Sri Lakshmi Estate Private Limited, Bombay Tribunal was dealing with a case where the agreement was registered in previous year relevant to assessment year 14-15, but the property was still under construction. Profits were not offered. The AO sought to tax the difference. The tribunal said, no, in the current year, there is no transfer because there is no property into existence. The agreement states that the property is under construction, and therefore the tribunal said that by registration of telling the agreement, what the assessee has done is it has only transferred rights in the flat and not property per se. And for 43CA to apply, according to the tribunal, there should be a transfer of property per se and not merely the rights. Now, 43CA has tolerance limits introduced on the lines of 50C, effective assessment year 19. Now, the tolerance limit question arose whether the tolerance limit so introduced is prospective or is it retrospective. The tribunal has taken up a position that the tolerance limit introduced in 43CA is prospective. Therefore, for all earlier years, even if there is a minor variation in the stamp duty between the stamp duty value and the consideration as per the document of transfer, the provisions of 43CA will be attracted. However, in the past, in the context of 50C, there are plethora of decisions telling you that look, your stamp duty value is merely a valuation, it's an estimate. Therefore, some reasonable difference needs to be tolerated. You had judicial precedents tolerating a difference of up to 10%, though the tolerance limit stated in 43CA initially is 5%, effective assessment year 2021, it's 21-22, it's going to be 10%. Now, stamp duty value on the date of registration has to be compared, or is it the stamp duty value on the date of agreement? As I mentioned, it is the stamp duty value on the date of agreement which needs to be compared with the full value of consideration. It is not the stamp duty value necessarily on the date of registration. You don't need any authorities, but nevertheless, if you need it, you have Bombay Tribunal in Guru Kripa developers and you have Ranchi bench of the tribunal in Panchwati promoters. Now, since the sections are pari materia, a question arises whether the ratio of all the decisions rendered in the context of 50C will apply to 43CA as well. And to my mind, the answer is yes, and this yes is also supported by the decision of the Pune bench of the tribunal in Bute Patil Properties versus ITO, where the Pune bench tells us that the case laws with regard to 50C will apply to 43CA as well. Now, if I go by this also, in the context of 50C, you have series of decisions that where an agreement was entered before 50C came into operation and the transfer happens after 50C was in force, the provisions of 50C are not attracted, following even the ratio of those decisions. To my mind, the decisions of the tribunal which we just saw in Index 1 and other two cases require reconsideration. Now, a small issue, Finance Act 18, effective assessment year 1920, has introduced a provision in 28(6)(a) saying that if you convert your inventory into a capital asset or your inventory is treated as a capital asset, then the fair market value on the date of conversion or treatment shall be regarded as business income. Fair enough. Therefore, what you're telling me is that if what I was holding as stock in trade, if I today decide to hold it as capital asset, the stamp duty, the fair market value, which as per rules is the stamp duty value on the date of conversion, will be brought to tax under 28(6)(a). Now, someone may say, what happens to the cost? You're saying the value needs to be taxed. I mean, I would regard that cost necessarily will have to be subtracted because we are under, I mean, 6A is clause of section 28. Section 28 deals with computation of profits and gains of business. It is not the gross amount which is to be taxed, but only the profits. But the point here to be noted is that does income accrue merely because I'm holding something as a capital asset and not as stock in trade? I was a builder. I constructed a building as my stock in trade with an intention to sell. Now I feel I need my own office. If I convert that building which I have constructed to be used as my office, what am I doing? I'm converting a stock in trade into a capital asset. Now what 28(6) says is that the stamp duty value on the date of conversion will be taxed, and correspondingly I'm told in 49(9) that such stamp duty value will be regarded as the cost or the fair market value which you are now adopting for taxation under the head business will be regarded as a cost while computing capital gains when you transfer the asset. However, 49(9) is effective from assessment year 1920. Possible that in the past I have converted some inventory into a capital asset. Possible that in the past I have converted some inventory into a capital asset, which I am now selling. Can someone tell me that, hey, look here, 49(9) is effective assessment year 1920. Therefore, I will not give you any deduction while computing capital gains. To my mind, the answer appears to be no. I will be able to argue that based on the ratio of several decisions which are saying that same income cannot be doubly taxed. Now, this is so far as now. How will the indexation be computed and how will holding period be computed? The indexation will be with reference to the previous year in which I start holding it as a capital asset. Same way, holding period also will commence from the date I hold the asset as a capital asset. Now, since we started late, what time are we? How much time do we have? May I ask the organizers, because we started quite late, about 35-40 minutes late. Hello. 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 Hello.
Yes, sir.
Yeah, how much time do we have? Because we started late, so I must know what topic to cover next. We started about 35-40 minutes late, so you want me to stop in another 5-10 minutes, or you want me to go on? What do you want?
Chalega, sir. 10 minutes.
Sir, sorry?
5 to 10 minutes,
yes?
chalega, sir.
Only 5 to 10 minutes. Okay.
Chalega, sir.
Okay. So then, I thought we started about 40 minutes late. So anyway, so then what I'll do is I'll deal with some of the issues with reference to COVID. Now, I'm skipping the portions dealing with holding as of immovable property as a capital asset for want of time. If later on the organizers feel I have further time, I shall cover it up. Now, under section 54 and 54F as well as 54 EC, you get some exemptions depending on when you have purchased or constructed the house. Now, 54 tells you that you are required to purchase or construct the house within a period of 2 years for purchase and 3 years for construction after the date of transfer of the first house. Now, supposing you transferred the property 2 years back and you are now required to purchase the property. The time period given in 54 is a period of 2 years. Let's presume that you transferred the property on 25th of March 2019. From the date of transfer, within a period of 2 years, you are required to purchase a new property so as to avail of the benefit of section 54. The 2-year period will expire or expired in 21. So let's take the date of transfer to be 18. Now, if you take the date of transfer as 18, your 2-year time period expires on 31st of March 2020. Now, the question is that in this atmosphere, it is not possible for me to go and purchase the house. So are we saying that my exemption of 54 and 54F is at stake merely because of the environment in which I am today. Therefore, will I be asked to pay a greater amount of tax, or will I lose the exemption which I am otherwise entitled to under 54 or 54F? Similarly, under 54 EC, I am required to make an investment in specified bonds within a period of 6 months from the date of transfer of the original asset. Supposing that 6 months was expiring sometime in April or May. Now, in April, we were in a lockdown situation and therefore I could not make the investment. Do I lose the exemption? The answer is no. Your taxation and other laws ordinance, read with the notification, tells you that if your due date for any of the things, for purchase, investment or construction, falls during a period from 20th March to 29th September 2020. So if you were required to purchase a new house, or you were required to complete construction of a new house, or you were required to make an investment in specified bonds within a time, and that time came in the period from 20th March 2020 to 29th September 2020, then the date stands extended up to 30th September 2020. So fine, for purchase, construction and investment, the date stands extended to 30th September 2020. However, when it comes to depositing money in the capital gains account, these 54 and 54F expect that if I have not utilized or appropriated the amount of capital gains or the net consideration on or before due date of furnishing the return of income, then within the due date of furnishing return under 139(1), I must deposit the unutilized amount in an account under the capital gains account scheme. Now, the due date of filing return of income stands extended to 30th of November by virtue of the ordinance read with the notification. Therefore, automatically the date by which I should deposit the unutilized amount of capital gains in the capital gains account is extended to 30th of November 2020. Now, if this date further moves forward, I may get a further extension. Right now, is anybody in difficulty? Now, if you appreciate, 54 and 54F permit you exemption even if you have purchased a new house 1 year before the date of transfer of the original asset. Therefore, in anticipation that I will sell my house and get a gain, I already purchased a new house first by borrowing the money. Because I was getting a good deal, I purchased the new house. I thought that my existing house I will sell once my children's school academic year ends, so that I shift to a new locality in the new academic year. And therefore, to fund the new house, I borrowed money, but that borrowing was temporary. I knew that I will sell my old house and make a gain. That gain which I make on sale of my old house would have been exempt, since I have already purchased a house 1 year before the date of transfer of the old house. Now the question arises that supposing I have already purchased a house, but because of this difficult situation, I am not able to sell my house. What happens? Or consider a case. So this is one set where difficulty arises and where I believe institute should make representations or use its good offices. The office bearers need to use their good offices and get clarification. At best, what you can argue on the basis of the decisions of the Supreme Court in a suo motu writ petition, as also of the Bombay High Court, that the period of, while computing this period of 1 year, do not compute the period for which the lockdown was in force. That is from about 24th or 25th of March till maybe 2nd of June, where the lockdown was lifted. Now, for this period, do not count. So if I purchase it thereafter, then possibly I may be able to argue that I should not be lose my exemption, where when you count this 1 year, the period of lockdown should not be counted. And if this period comes in between, then I get an extension to the extent of lockdown period. Now consider a case, another case where an assessee has received advance for sale of his house before the lockdown. The buyer deducted TDS under 194 IA on whatever amount he paid. Some amount was remaining to be paid. The buyer was looking out for a loan, etc. So that loan documentation was yet to be done, and therefore the final agreement could not be signed. Since final agreement was not signed, I have not transferred, I have not even given possession. But mind you, I have received an advance before March. I knew that I'm going to make a gain. There is an agreement with the buyer, though not stamped and registered, but there is a memorandum of agreed understanding, agreed terms, wherein I have agreed to sell my house. I've received an advance. There has been a TDS under 194 IA. In anticipation of that, I planned that I will invest some money in bonds under 54 EC, and I will also, and on the balance, I will pay tax. Whatever tax was required to be paid on the balance, I have paid by way of advance tax on 15th of March. Now you may say, then what is your problem? The problem is the lockdown. The problem is COVID. With COVID coming, with lockdown happening, I could not transfer my house by 31st of March. So there is no transfer document. I have not even given possession in part performance. Even if I would have given possession in part performance, a question would have arisen that the possession is not under a registered agreement, and therefore 247(5) would not have applied in view of the Supreme Court decision in Balbir Singh Naini's case. Therefore, what happens in such cases? Here is a case where I have already paid tax. Not only paid tax, some part has been deducted at source, but the transfer is happening in a subsequent year. In subsequent year, I will again be required to pay advance tax. Therefore, the board must come out with a clarification or some sort of a system whereby such advance tax and TDS automatically gets adjusted towards the tax liability for a subsequent year, because otherwise I will be required once again to pay advance tax for a subsequent assessment year and claim refund of advance tax for assessment year 2021 already paid. Now, is there a way out of this situation? Possibly the decision of Supreme Court in Sanjeev Lal's case may come to the rescue of an assessee. If you have a written agreement and you have received some money by check, relying on the decision of the Supreme Court in Sanjeev Lal's case, you may argue that, look here, I have already transferred. There is an extinguishment of my rights in the asset. Having signed this agreement, I cannot now deal with the flat. Therefore, transfer has taken place in that year in which I have entered into an agreement, though there may not be a registered conveyance, though possession may not have been given. This exactly were the facts, similar were the facts in the case of Sanjeev Lal as well. And Supreme Court, while deciding whether the assessee was entitled to exemption under 54 or not, held that you must regard that the transfer has happened on the date on which the agreement was entered into by the assessee. Now, these are some of the decisions which, some of the issues which could arise because of the lockdown. Now, the
Sir,
5 or 10 minutes granted to me are over. So, yeah.
Yeah, sir. Excuse me. Sir, we do have
Yes,
time available because we understand your topic is very relevant, very important for all participants, and it's starting little late also. So, sir, we can take 5-10 minutes extra. There is no issue because everybody wants you to listen.
Okay. So, what you want me to continue for how long? You tell me, so I'll take appropriate issues then.
Yes, sir. 5-10 minutes we can take. 5 to 10 minutes. Yeah.
Okay, fair. Okay. Now we come to the third set of issues, which is where real estate is held by me as my capital asset. So the first issue is the holding period. Now, as you may be aware, section 242A has been amended and by the Finance Act of 2017 and Now, the holding for an immovable property being land or building or both to qualify as a long-term capital asset, the holding period is no more 36 months, but it is only 24 months. Therefore, if the capital asset is an immovable property being land or building or both, then such immovable property being land or building or both will qualify as long-term capital asset if on the date of transfer it was held by me for a period of 24 months or more. Earlier this was 36 months. So now what's a great deal? Why do I need to take this in DTRC where we have such august audience? Because I need to take it because of several issues which arise from this amendment. Now, what are the issues which arise? I'll first list down the issues and then we'll address them one by one. When you say immovable property being land or building or both, do you mean only land or building, or do you also mean rights in land or building? That's first issue. So now the answer to that will take color from what meaning you give to the term being. Also, please note that here you have immovable property before being. Therefore, the question is being suggestive of examples which are following being, or is being suggestive of the exhaustive nature of the list which is following the words land, word being? This is the first issue. Second, when I transfer part of a building, will the amendment apply or no? To my mind, let me sort this out. Yes, whole includes part, and therefore it will apply. Will this amendment apply to a flat under construction? I booked a flat under construction. A period of more than 2 years is over, but a period of more than 3 years is not over. Therefore, I am somewhere in the 26th month. Now, if I transfer the rights which I have under that agreement in respect of a flat which is still under construction, will you treat it as a long-term asset or will you treat it as a short-term capital asset? To my mind, highly debatable, or rather I would take a view that the time period of 24 months or the amendment will not apply to such cases, to a flat under construction. Why? Because that will not qualify as building. What I have is maybe an interest or a right to enforce the transaction via the seller. The next issue or the next point to be noted is, while there is an amendment into 42A, there is no corresponding amendment in section 54 and 54F. 54 requires me to hold the new house for a period of 3 years. If I sell it before 3 years, the consequences stated in 54 follow. Same way, 54F also has a similar provision similar to 54. Now, therefore, the question is, does this have any repercussions? Meaning, there is an amendment here in 242A. So, if I purchase a new house and avail of an exemption under 54, after 2 years, the new house will qualify as a long-term capital asset going by 242A, but 54 still requires me to hold the house for a period of 3 years. If I do not do so, certain adverse consequences follow. Now, this and one or two other issues, let's start dealing with them. Is the amendment prospective or is it retrospective? Obviously, the amendment is prospective. Will it apply to assets acquired after the amendment or assets transferred after the amendment? The answer is it will apply to assets transferred after the amendment. The date of acquisition is entirely irrelevant, so to say. Now, immovable property being land or building or both. Now, what is the meaning of immovable property? I don't find any definition in Income Tax Act. I go to General Clauses Act. It tells me immovable property shall include land, benefits to arise out of land, and things attached to earth or permanently fastened to earth. Now, looking at this definition, I get an impression that land is something else and benefits to arise out of land is something else. Because if they both were same, legislature here would not have said immovable property shall include land, comma, benefits to arise out of land. If benefits to arise out of land are same thing as land, there was no need for you to mention that phrase separately. Therefore, admittedly, benefits to arise out of land is something different from land. Now come to the meaning of the term being. A being can be understood in two ways. The first is that the word being means which. The word being means namely. Therefore, what follows thereafter is exhaustive, right? The immovable property being land or building. Therefore, immovable property which is land or building or both. Immovable property being, therefore, the Odisha High Court in industrial development tells me that being means namely. Therefore, immovable property, namely land or building. Therefore, it will not apply to anything which does not qualify as land, anything which does not qualify as building. The other view is the view taken by Madhya Pradesh High Court in the context of section 35D, and it says that the words which follow being are only example. Being is illustrative. Therefore, immovable property being land or building. Therefore, going by the second view, being is only an illustration. Now, mind you, the phrase land or building or both is a phrase you have in 43 CA, is a phrase you have in 194 IA, is a phrase you have in 50 C. The view taken, now incidentally, you also have this phrase in 54 EC. You cannot in one provision contend that your rights are included, and therefore if I have held rights in land for a period of more than 2 years, it will qualify as long term. Then if you take this position here, you will have to take up the position even in the context of 50C or 43 CA. What is the safer view? Safer view would appear to be, to me, the safer view would be that confine the provision to be applicable only to land or building or both. Do not make it confine it to other categories of immovable property. Now, what happens to 54 and 54F, the issue which we saw? If I transfer the house, the new house, after a period of 2 years, but within a period of 3 years, so in the third year, so to say, if I transfer the new house, will the gain be long term or will the gain be short term? The answer is gain. Then the question arises, now if I once again want the gain to be invested after the, so I sold one house and I purchased another house. That another house, the second house which I purchased, the new house, so to say, has been held by me for a period of 27 months. Now I am selling that house. When I am selling this house, there is a gain arising. Is this gain long-term capital gain or is this short-term capital gain? I would believe it is undoubtedly a long-term capital gain. Now I want to switch over to another house. Can I get exemption, or will someone tell me, hey, wait, the gain which you are now making has two components. One is the old gain which you claimed as exempt, and second is the gain proper of the new house. To my mind, the answer is very clear in 54(1). It says that if you transfer the new house within a period of 3 years for the purpose of computing in respect of any new asset, any capital gain arising from its transfer meaning transfer of a new asset, within a period, the cost will be nil. Therefore, 54 is deeming the cost of the new asset to be nil. The gain will still continue to be gain of the new asset. It will not be regarded as a gain of old asset not eligible for exemption. Now, when you come to 54F, the fiction there is that whatever exemption you were given earlier, that exemption shall be deemed to be income chargeable under the head capital gain relating to long-term capital asset. So the gain which I claimed exempt on the sale of my first house will now be brought to tax under 54 54F by virtue of 54F3 as being income chargeable relating to long-term capital asset. Will a flat in a cooperative society qualify as a long-term capital asset if it is held for a period of more than 2 years? Matter not free from doubt. Quite arguable to say yes, in effect, it is a building which I'm owning, but the form is it is a share of a society attached to those shares or married to the shares is the right of occupation. Therefore, there could be some gray area there, some doubt, some litigation one may envisage, though quite likely, quite possible to take a view that yes, the holding period of 2 years should apply to a flat in a cooperative society. Now, what all will be land and building or not, whatever we discussed under 43 CA, the ratio of those decisions should apply over here. What will definitely not get covered is leasehold rights, rights of a buyer of land or building under an agreement to sell. The example of an under construction flat, which I gave you, tenancy rights, transferable development rights in land. These would not be covered. A building under construction will not be a building. What then is building? Punjab and Haryana High Court tells me building means a completely built structure which has a roof, a dwelling place, walls, doors, windows, electricity, and sanitary fittings, etc. If one or more of such components are lacking, it cannot possibly be said that the building is a complete structure for the purpose of Wealth Tax Act. The Punjab and Haryana High Court was dealing with the Wealth Tax Act. Now, is part of a building also building? I would believe yes, part of a building is building. Now, we have series of decisions starting from Rajasthan High Court in Vimal Chand Gorecha to Madras High Court in Ramchandra Rao, Citibank, Bombay High Court, and Kerala High Court in Lakshmi Menon, telling us that if I have been holding land for a period of, the holding period of land is different from the holding period of building. It is possible to take a view that the two are separate assets. Land can be long term and building may be short term. Therefore, if I have purchased a land 27 months ago, but the building thereon constructed is only 15 months old, then when I sell it, and if I sell it separately or consideration of the two is separate, then it is possible for me to contend that land has been held for a period of more than 2 years, and therefore land is a long-term capital asset, whereas building has been held by me for a period of 15 months. The gain arising building will therefore be a short-term capital asset, giving rise to a short-term capital gain. Right? I think I have dealt with this. Now, okay, one small point. Let me make it. Now, effective assessment year 15-16, 54 and 54F have been amended to provide that the new house should be only one house. In the past, what was happening was that I used to sell one house and I would go and purchase more than one houses. There were decisions of the courts saying that there is no restriction that I cannot purchase more than one house. Law got amended, 54 and 54F were amended, and now the position is that I will get exemption only qua the investment in purchase or construction of one residential house in India. I'm not on in India or outside India for a moment. I'm only on that I need to invest the gain in one purchase or construction of one residential house. What I'm now considering is that supposing I have sold 3 houses, I've sold 3 flats. The gain arises on transfer of 3 flats. These 3 may have been sold in 1 year, may have been sold in 2 different years. But within the time period mentioned in section 54, I go and I purchase a new house. And the gain arising on all these 3 flats is invested in purchase of one house. Will the entire gain in respect of all the 3 houses qualify for exemption under section 54, or will you tell me, hey wait, we are going to give you gain of only one of the houses as exempt, while the gain made in respect of the other two houses, we will not give you an exemption under 50. Therefore, to put it simply or in general words, gain from many, can it be invested in one? Is many to one type of a situation permitted, or is only one to one permitted? Therefore, exemption will be only qua gain made on transfer of one asset or one house, if it was 54 and 54F, one transaction. To my mind, and rightly held by not one but three decisions of the tribunal, there is no restriction in 54 that gain in respect of only one house will qualify for exemption under 54. Therefore, if I make gain on selling even 7 flats, the gain of all 7, if I go and I invest in purchase or construction of one new house, the gain of all 7 will qualify, subject of course to the investment having the purchase or construction being made within the time period mentioned in 54 and other conditions of section 54 being satisfied. Now, which are the decisions? The decision is, I'm not getting into the facts. The facts are very well narrated in the presentation. You can go through it. The decision is in the case of Bipin Sagar, where the person sold 3 adjoining residential flats in a society. He went and purchased one house. The AO said, hey, you have sold 3 houses. The argument was twofold. One, it was not 3 houses, it was 1 house, because I was using it as one residential house. It had 1 kitchen. Even if you disregard that house, that argument, the second leg of the argument was, nowhere does the section 54 say that gain of only one house will qualify for exemption. I have invested gain of all the 3 in one purchase of one house, therefore I should be getting an exemption. The tribunal held that the decision taken by the CIT appeal is correct. It upheld the order of the CIT appeal. Reliance was placed on decision of Bombay Tribunal in Ranjit Vithal's case and Rajesh Keshav Pillai's case, which are to the same effect, that yes, you can claim exemption by investing in one house the gain of more than 1 houses. Now, another question which arises is that if the gain is in 2 years, will I still qualify? The answer lies in the decision of the tribunal in Ranjit Vithalas, where the tribunal says even if 2 flats are sold in 2 different years and the capital gain of both the flats is invested in one house, exemption will be available in case of sale of each flat, provided time limit is satisfied. Time limit mentioned is satisfied. Fair enough. I mean, the tribunal says that wherever legislature wanted to restrict the exemption to 1, it has stated so very clearly. For example, they say when it comes to section 23, you are told annual value of one house will be taken as nil. So where legislature wanted 1, it has specified that it wants to restrict the exemption to 1. Now, another question arises that if I sell an asset, can I claim exemption under 54 and 54F? Both if I sell 2 assets, say I'm selling one house and I'm selling land, the gain from house will qualify under 54, whereas gain on sale of land will qualify for exemption under 54F. Can both these be invested in purchase of one house? And I say that gain of both these assets, one qualifying under 54, another qualifying under 54F, I am investing in purchase of only one house? The answer is yes. And you have Hyderabad Tribunal telling you that in Ramana Umaradi's case. For want of time, I'm not getting into the nitty-gritty of calculation. There could be some issue here on the calculation. Which one do I calculate first, exemption under 54 or 54F? Last a minute on whether deposit in capital gain account as required by the provisions of 54 and 54F is a mandatory requirement, or is it a technical or a venial requirement? And therefore, if I have not complied with the requirement of depositing the money in capital gains account, I do not lose my exemption. You have series of tribunal decisions telling you that it is only a technical or a venial breach Therefore, if at all you have purchased or constructed the new house within the time limit mentioned in 54 or 54F, your exemption is protected. However, please make a note, Bombay High Court, jurisdictional high court, as far as we are concerned, in Humayun Suleiman Merchant, takes a position that failure to deposit the consideration in a specified bank account is fatal to the claim of exemption. The fact that you have purchased or you have utilized the entire amount before the due date, last date of filing return of income, according to Bombay High Court, is entirely irrelevant. Right? One or two issues are left, but they, according to me, we can live with not doing them. You can go through the presentation. The presentation is in detail. I'm sorry if I have rushed, but it was due to paucity of time that I wanted to cover maximum issues, and I went a bit parts at certain places. I hope I have made myself clear in whatever I have discussed. Thank you.
Thank you so much, sir. It was very professionally presented because the issues which are there, and you are trying to cover a lot of many practical issues, case laws, recent amendments, judgments. A lot of things are covered in a very, very short span of time. And I think this DTRC series has been every time, every day, they are receiving a very good response. Before this COVID-19, there's always an issue regarding coming and meeting. Now, with these 3,000 plus participants are there and they are here to listen to you. So that shows that whatever may be the challenges, whatever may be the issues, but these are going to be fade away. It reminds you of a small thing. कुछ सिखाकर ये दौर भी जाएगा, कुछ सिखाकर ये दौर भी गुजर जाएगा, फिर एक बार हर इंसान मुस्कुराएगा। मायूस न होना मेरे दोस्तों इस बुरे वक्त से, मायूस न होना मेरे दोस्तों ये बुरे वक्त से, कल आज है और आज कल हो जाएगा। So I think this is what we have done learning throughout this scenario, and this COVID-19 is going to be go away very soon. We all will be back with lot of changes, and the most important, sir, my heartful thanks to you, Jagdish Bhai Punjabi sir, for sharing your valuable time. The challenges which you have taken, the case laws, the issues which you have gone to detail, it means that it's a real estate is an ocean of laws and regulations. A lot of things are there, a lot of issues are there, which require the full day of yours to deal in detail. So, however, sir, you have done fantastically well by managing the whole time and ensuring to provide the maximum output to all participants. Thank you so much again, sir, and we'll be there. We'll again call you very soon to listen in detail. My thankful to all the participants for staying late. I understand the 5 o'clock was the timelines, but the way the topic was going on, the way the speaker was handling the whole audience, everybody was staying till end. So my thankful to each one of you for staying there till end. We are going to back again. DTRC is continue. See you soon again. Thank you so much. With this, we end this particular presentation. So now we are ending it.
Yeah, thank you.